perspectives of operators and industry experts post-COVID-19. My name is Rolake Akingwe-Filani, and I'm delighted to have been invited to be your facilitator for today's virtual event. Many thanks to Mr. Oscar Onyema and his NSC team for the honor. And kudos to the NSC for leading this charge to ensure that the oil and gas sector remains at the forefront of financial and capital markets conversations in Nigeria today. As you know, the global energy industry is no stranger to volatility, geopolitical instability, price wars between oil-producing countries, and many more aspects of risk. Now, add COVID-19, which at its height wiped away nearly 30% of world energy demand and literally brought the world to a standstill. And there you had the makings of a perfect storm. We saw a first quarter that saw free-falling crude oil prices, stranded crude cargoes of some of the most sought-after crude grades, negative prices for crude futures, and a global economic shutdown. And I think at some point, many of us were left wondering where the bottom of the hole was. Nigeria as a country has always been known for its resilience, and somehow its oil and gas sector still thrives, albeit cautiously. So much has changed about the world around us, and in some ways, so little has also changed. There have been a variety of responses from industry operators and policymakers. We've seen some divest non-performing assets, optimize investments in mergers and acquisitions. We've seen attempts by operators to deleverage and focus on shareholder returns and explore innovative financing structures. As we get into the session, the panelists and the participants will shed more light on how we got here and how they've successfully navigated 9 months of this crisis to ensure business continuity. Prior to COVID-19, oil and gas underperformance in global capital markets was already a major challenge as a result of low return on invested capital. Investors were already focused on emerging dynamics that could alter the industry structure, such as a focus on environmental and governance issues or the focus on decarbonization. And historically, capital markets have been seen as providing an avenue to access long-term liquidity and financing. Bonds, for instance, were seen as an avenue to refinance very expensive commercial debt, and public equity markets were also providing an option for private investors to exit. However, the series of pandemic-related sell-offs we're seeing have not just happened globally, but regionally and locally. So all the stakeholders we've brought today will help us provide ideas on how to re-strategize and ensure that institutions like NSC and local capital markets in general play an even more central role in reigniting investor appetite, in helping operators build sustainable business models and weather the storm, and more importantly, in accessing the capital they need to ensure the sector's continued contribution to sustainable economic development and a secure future, I must add, for our young people and society at large. I'm thrilled to say that today's discussion will help us get to the bottom of some of these issues, and we're set to hear diverse perspectives from both the public and private sector, and within that, the inclusion of a variety of business views from the upstream, downstream, oil services space, and from policymakers, financial advisors, and regulators. And you will all have the opportunity to ask questions that are pertinent throughout the webinar. So without further ado, it gives me great pleasure to invite a stalwart of financial and capital markets and an accomplished professional who has been unwavering in his support for the oil and gas sector in his almost decade-long stint at the NSC. Please welcome the CEO of the Nigerian Stock Exchange, Oscar Onyema, OON, to give his opening remarks. Over to you, Oscar. Thank you.
Thank you very much. Good morning, distinguished ladies and gentlemen. Let me first of all thank all of you for joining us today for this webinar, which is part of our thought leadership offerings. The Nigerian Stock Exchange is pleased to host this webinar at this critical time in our strategic and advocacy drive towards supporting the Nigerian oil and gas sector. The NSC views it important to provide thought leadership, especially during these times with the world facing unprecedented challenges occasioned by COVID-19. Beyond a health crisis, governments and corporations are saddled with the responsibility of overcoming the impact of the pandemic on markets and global economies. I thank our distinguished speakers and guests for making our time to participate today, despite your busy schedules. As you are aware, the oil and gas sector remains arguably one of the most critical sectors to the Nigerian economy. Given its sensitivity to external shocks and the sector's strategic importance to government revenue, the faltering global demand for crude and recent collapse in oil prices has heightened future uncertainties for the sector. However, these challenges present as a backdrop for future opportunities for governments, regulators, and operators to adopt innovation across existing verticals and pivot towards growth areas. Indeed, a recent report by McKinsey connotes that the COVID-19 crisis accelerated potentials for innovation in the oil and gas sector. According to the National Bureau of Statistics, in Q2 2020, total contribution of the oil and gas sector to GDP was 1.42 trillion naira, indicating a decline of 6.63% from Q2 2019, where total contribution stood at 1.52 trillion naira. The sector also recorded a decline of 10.82% between the first two quarters of 2020. Although these numbers may be reflective of the overall performance and current realities of the Nigerian economy, there is no denying the long-term uncertainties within the oil sector, particularly given the volatile nature of crude oil prices and the surge in global demand for alternative energy. We must, however, commend ongoing efforts of the Nigerian government towards energy diversification and the recent policy reforms within the sector. Worthy of mention is the 250 billion naira intervention facility by the Central Bank of Nigeria for the National Gas Expansion Program, targeted at increasing domestic utilization of compressed natural gas, CNG, and liquefied petroleum gas, LPG. The push towards local energy sufficiency with the construction of modular refineries in different parts of the country through private-public partnerships is also laudable. The exchange is also aware of the gradual shifts within the oil and gas sector and the global demand for green energy and green finance. For instance, the market for green bonds is one of the fastest growing in the world, with an increase of 51% observed in 2018 to USD $257 billion globally issued in 2019. The exchange continues to provide a platform to access a global pool of capital to aid asset acquisition, business expansion, debt refinancing, and other objectives of governments and corporates. In recent years, issuers operating in the oil and gas sector have raised over 400 billion naira across several asset classes on the exchange. We continue to collaborate with the relevant stakeholders to provide the appropriate framework supporting diversification towards renewable energy, and we are also well positioned to facilitate needed capital formation. Since the launch of the first green bond in 2017 on the Nigerian Stock Exchange, we have listed other green instruments issued by governments and corporates to the tune of 49.2 billion naira to support various projects that are green compliant. The NSC has also pushed to increase its product offerings to the investing public and corporates with the scheduled introduction of special purpose acquisition companies, or SPACs, which aims to provide promoters with a vehicle for capital formation. SPACs can be utilized to aggregate and channel funds required for highly capitalized projects or asset acquisition in the marginal field space, amongst other areas of interest, and represents a new stage in the development of the Nigerian capital markets. Our collaboration with the London Stock Exchange and other global exchanges is deliberate and strategic. It is geared at encouraging seamless cross-border access between our capital markets to ultimately deepen the markets, create larger pools of liquidity, and greater competitiveness for our prospective issuers and listed companies. This brings me to policy advocacy and strategy execution of the Nigerian Stock Exchange. In ensuring positive impact to the private sector, and more importantly, our listed companies, we continue to engage the federal government on notable opportunities for the development of the oil and gas sector and providing thought leadership in deliberations with government on more efficient ways to utilize the country's massive gas deposits. At the Nigerian Stock Exchange, we recognize the importance of a well-developed capital market and its position as a barometer of economic development. In our efforts toward achieving economic prosperity, we continue to provide a fair and transparent market for capital formation in order to support infrastructure development and sustainable growth across all sectors of the economy. I therefore would like to encourage more companies within the oil and gas sector to take full advantage of the opportunities and the deep pools of capital inherent in the Nigerian capital market to meet their growth and strategic objectives. I have no doubt that we are all well positioned to attract right-sized international and domestic capital required to drive the country's much needed economic reforms and sustainable growth. Distinguished ladies and gentlemen, I thank you all once again for your attendance. I encourage you to participate fully in the discussions, as this would catalyze practical solutions needed to positively impact the oil and gas sector, and indeed the Nigerian economy as a whole. I welcome you all and wish you very fruitful deliberations. Thank you very much.
Thank you very much, Mr. Oscar Onyema, NSC CEO. You said so many very pertinent things, but I was also particularly struck by the pioneering spirit of the NSC. I think you mentioned that almost 50 billion worth of green instruments had been listed on the exchange so far. And that is pretty impressive. And kudos to the NSC for those pioneering and innovative steps it is taking. So we're going to move right on. And next we have the GMD of NNPC, Malamele Kyari, ably represented by Mrs. Rose Eshet, the Group General Manager for Finance at NNPC, to deliver a goodwill message and presentation from GMD. Thank you very much for being here with us today, ma'am. Over to you.
Thank you very much, Olaki. Thank you, everyone. The Honorable Minister of State for Petroleum Resources, His Excellency Chief Timbre Marion Sylvia, distinguished ladies and gentlemen, On behalf of Mele Kolokiari, the Group Managing Director of NNPC, I wish to bring the forum, a goodwill message. Please allow me to share my presentation online. I don't know whether can everyone see that? Hello?
Hello, ma'am. We can't see it yet. We can't see it yet. So if you would please kindly share your screen, or we can ask the host to share it on your behalf.
I think it's coming up.
Okay.
Is it okay? Can you see it now, please?
Yes, we can. Please proceed. Okay. Perhaps you want to put it on the slideshow view.
Is that okay now? Well, okay,
okay, it is okay. Thank you very much.
Okay, once again,
you are on. You may proceed.
Thank you once again, ladies, distinguished ladies and gentlemen. I would want to start with the almighty COVID-19. Well, the COVID-19 virus was declared as a public health emergency by the World Health Organization on the 30th of January 2020, and as a pandemic on the 11th of March 2020. This pandemic has created so much unprecedented and global crisis that has caused regions, countries, sectors, companies, and even individuals to experience a reaction, resilience, recovery, and adjustment to a new reality. As part of efforts to stem the spread of the virus, major economies of the world instituted lockdowns aimed at minimizing human-to-human interactions. This has in turn resulted in economic challenges, and a cure is yet to be found. Countries have, however, tried to find a way to balance the economic shocks of these extended lockdowns and restrictions with the associated public health risk. Over the last 8 months, we have seen crude oil prices coming down with the sharpest drop in the history of the crude oil business to about 69% reduction, from a peak of $60.94 per barrel in December 2019 to about $18.84 per barrel in April 2020. This was, however, triggered by Russia and Saudi Arabia, both of whom were unable to agree on oil price cuts to match the fall in demand due to reduced economic activities by the COVID-19 pandemic. With this economic activity slowly resuming, oil prices have, however, started to rebound. And as of 3 days ago, Brent prices have risen up to $41.075 per barrel, indicating a healthy recovery trend. The global economy is, however, projected to contract by about 3% in 2020. What has COVID-19 done to the whole world? Work lives have changed quickly in response to the pandemic, requiring us to find new ways to collaborate as we consider the safety of our co-workers and families. The economic impact expectedly is felt more by community-rich exporting countries like Nigeria, and it has been projected that there will be a drop of about $2 trillion to $3 trillion US in most of these economies. The impact of the twin shocks, that is COVID-19 and low crude oil prices, is intense in Nigeria. As a result, about 2.6 trillion oil revenue has been, we have seen a decline of about 2.64 trillion naira, which is about 40%, in what was, earlier projected. For us in the oil industry, for the upstream projects, seeing delays as a result of restrictions, and there's been scaled down, by government investment in this sector. For the downstream projects under construction, they've experienced some delays in execution due to the disruption in supply chains. For the midstream and oil field services players, they've suffered existential threats as most of their contracts were terminated. Other challenges can be seen in drop in oil and gas prices. The energy industry is likely to continue to struggle in the wake of a precipitous drop in oil and gas prices due to dampened demand from the effects of COVID-19. And we are also seeing depressed revenue, which means that revenue and production declines will likely continue to present major challenges for oil and gas companies like us, especially for those at risk of being unable to refinance debt or meet existing debt covenants. As a result, the industry could well face potential bankruptcies. There's also oversupply of crude oil. As crude oil prices are falling due to oversupply, there's also a rapid decline in demand, both domestically and internationally. We also faced with inventory problems. The depleted demand for petroleum products has created inventory problems in both the distribution network and at the refineries. We are also witnessing prolonged recovery period. The industry may still be looking at a prolonged recovery period lasting as long as 2 years based on historical production decline curves. So what are the emerging opportunities in the oil and gas industry? We are saying that the passage of the petroleum industry bill will remove uncertainties and create investment opportunities in the oil and gas sector. The stakeholders, therefore, in the oil and gas sector are encouraged to prepare for recovery despite the slowdown, as opportunities abound in the Nigerian oil and gas sector post-COVID-19. To be more specific, in the upstream sector, with 40 billion barrels reserve and a 3 million barrels per day production target, there's a potential investment opportunity for in-country storage capacities for crude oil. In the downstream sector, the deregulation of the downstream sector has created more investment opportunities that will engender competition. And we're therefore encouraging the establishment of modern refineries to meet the huge demand for the refined products. For the midstream and the oil service sector, the industry players should be exploiting the country's abundant gas reserves for in-country consumption. Private firms should support major partners in the establishment of the integrated power plants along the Abuja-Kaduna-Kano gas pipeline project. There's also a major opportunity in the energy transition. The AKK project, that's the Abuja-Kaduna-Kano gas project, will provide energy sources for industrial areas in Idu, in Abuja, Kaduna South, Bompai, and Sharada in Kano. The government initiative on the use of compressed natural gas is an opportunity for industry players to explore. To reposition the oil and gas industry for sustainability post-COVID, there must be collaboration across different dimensions. That means that both government, industry players, and particularly the host community must collaborate to find a way forward. Therefore, the oil and gas sector players should manage costs, improve efficiency, and deliver required cash flow for reinvestment and expansion by taking advantage of opportunities that will keep the industry viable and ready for post-COVID-19. This means that innovation will also play a crucial part as we look forward to post-COVID-19. I would therefore want to conclude my goodwill message with this Chinese proverb, which is a quote from John F. Kennedy. It says that the Chinese use 2 brush strokes to write the word crisis. One brush stroke stands for danger, the other for opportunity. In a crisis like we are facing now, be aware of the danger, but also recognize the opportunity. At this stage, ladies and gentlemen, I want to once again welcome everyone and to wish everyone a fruitful deliberation. Thank you very much.
Thank you very much, Mrs. Rose Eshet, the GGM for Finance, Nigerian National Petroleum Corporation. Very, very impactful passing words from you on the opportunity in the sector, despite the obviously challenging environment. Thank you once again, and please extend our thanks to the GMD of NNPC, Mele Kiari, for his support and continued collaboration across the sector. So now we move on to our...
Thank you, everyone.
Thank you, you're welcome. So now we move on to our keynote address, which we've all been waiting for in anticipation, and we have it from none other from the Honorable Minister, His Excellency Chief Timipre Malin Silva, Honorable Minister for State for Petroleum Resources. It's good to have you, sir. Thank you very much for joining us, and we look forward to your presentation.
Thank you very much. let me on the protocols already established. I am pleased to deliver this address at the 2020 Nigeria Stock Exchange Oil and Gas webinar, themed Perspectives of Operators and Industry Experts post-COVID-19. It is no longer news that the energy industry is currently faced with critical challenges to eliminate carbon emissions in the global space, achieve cost efficiency in the operational zones, grapple with competitiveness in the market environment, and overcome the effects of COVID-19 scourge. Nigeria, a major player in the energy industry, has been in the thick of this. The energy industry is historically renowned for its resilience and ability to navigate through tough times that had occurred in the past. The Great Depression of the 1930s, several supply gluts, economic recessions, and more recently, the financial crisis that rocked the world in 2008 to the advent of COVID-19. Crude oil prices nosedived globally, largely due to the following factors. Crude oil production and price war between Saudi Arabia and Russia. That has already been mentioned by the GMD. Trade war between China and the United States of America. Supply gluts as a result, weakening global crude oil demand. As a result of weakening global crude oil demand, new discoveries around the world, global transition from fossil fuels to renewable energy. Nevertheless, the COVID-19 pandemic is unprecedented in upsetting the dynamics of the global energy situation, bringing about multi-pronged assaults on the Nigerian economy and culminating in loss of revenue, deferred investment, and slowdown of growth and development. These overarching effects have made the need for innovative adaptability in the industry inevitable. It is obvious that industry players must adapt in these unusual times. Moreover, the global relevance of crude oil is increasingly diminishing. Thus, all efforts must be geared towards optimizing production at lower cost. Our fiscal regimes must be urgently tweaked under peaceful socio-political environment to achieve this. We are assured that Nigeria's oil and gas industry will emerge stronger from the current challenges as all players with concerted resilience begin to deliberately apply strategic solutions to issues to enable quick recovery and economic sustenance. That is why the 2021 budget is nicknamed the Budget of Economic Recovery and Resilience. To key into this vision, the following must be taken head-on in our quest for the desired recovery. Cost reduction to enable adequate return on investment. Accelerated passage of the Petroleum Industry Bill to unleash stable investments. The support for the full deregulation of the petroleum downstream sector to guarantee industry stability and sustenance. Encourage in-country refining capacities through private investment. In addition, the Nigerian Gas Expansion Program has been designed to stimulate the promotion of gas as alternative fuel for auto and domestic use. This, I believe, will save the nation from overdependence on white products and also deforestation, while creating jobs that will take millions of Nigerians out of poverty. You may all recall that we have launched the Nigerian Gas Transportation Network Code, which is currently opening up business participation in the gas subsector and will invariably impact positively on the growth and economic development of our country. In conclusion, the energy industry volatility aggravated by the COVID-19 pandemic, leading to progressive decline in crude oil price in 2020, has made it unavoidable for Nigerian industry players to seek innovative changes or be forced by the tide to abdicate the stage for more resilient players who are willing and able to do things differently. We are optimistic that the panelists today will proffer additional solutions to stimulate the needed growth and sustainability of the oil and gas industry post-COVID-19 and crude oil price bust. I congratulate the leadership of the Nigerian Stock Exchange for organizing this timely event and wish you successful deliberations in this virtual summit. Thank you.
Thank you very much, His Excellency, the Honorable Minister of State for Petroleum Resources, Chief Timipri Silva. We are really, really grateful for those words, and it was music to our ears to hear some of the things you mentioned around cost reduction, domestic refinery, the swift passage of the petroleum industry bill, and of course, the reforms in the gas sector, very, very important for the development of the industry. Thank you so much, sir, for your time. We're indeed very, very grateful, and we look forward to continuing the conversation with you beyond this webinar. Thank you again, sir.
Thank you very much.
Thank you. So, ladies and gentlemen, we're going to move on, and we would like to get our audience involved in the conversation. So now we're going to take our first of 3 Zoom polls today. And very shortly, you will see the question come up on the screen. I believe the admin team are about to put the question up on the screen. And the question is, what aspect of your business was the most impacted by the COVID-19 pandemic? First, business operations. Second, production and output. Third, revenue and profitability. Or fourth, funding and financial challenges. What aspect of your business was most impacted by the COVID-19 pandemic? So we would like as many of you to respond as possible, and we'll just give it about 50 seconds or thereabouts. Okay, so perhaps the admin team can show us the poll results on the screen. If we have it. Okay, cash is king, revenue and profitability. I'm sure if we could all select all 4 options, I'm sure many of us would actually select all 4 options. So we had company revenue and profitability at 58%, followed by business operations. Then we had fundraising and financial challenges at 26%, and production output at 15%. Thank you very much, everybody, for your participation. I think many of these areas will be discussed as we move along with the webinar. And perhaps then it is timely to introduce my next presenter, Mr. Alex Bagansky, who is head of oil and gas coverage at Renaissance Capital. He's going to be presenting on the global oil and gas outlook, after which we'll have an opportunity to pose a few questions to Alex. So at this stage, I would just like to briefly talk about the Q&A protocol. If you have questions you would like to ask, please put them in the Q&A chat box at this stage, and we'll try and incorporate as many of them as we can. So over to you, Alex, for your presentation. Thank you.
Okay, good morning, Rolaki, and thank you for this introduction. It is an honor and a privilege to be here. And over the next 15 minutes, we'll try to explain to you our views on the current situation of the oil and oil products markets, and also maybe give some highlights as to our perception of the main issues facing the Nigerian oil and gas sector that perhaps could then be addressed during the panel discussion. With that, let me share
Alex, if you wouldn't mind my brief intervention, may I kindly ask you to please increase your volume, if possible?
Of course, sure. I will try to speak louder.
As high as you can, as high as you can, yes.
Okay, thank you. Thank you very much. So let me just go briefly over the next 15 minutes through some of our thoughts on the key elements of the oil markets today and our outlook on how things will change over the next few months. And then I will also try to raise some of the key issues facing the Nigerian oil sector at the moment, that those issues perhaps can then later be addressed during the panel discussion. So let me start by summarizing that we think that as far as the oil market is concerned, we believe that we're currently in the period of the recovery. There is a combination of demand recovery, inventory reductions, and our expectations of already high but also improving level of compliance with the OPEC Plus deal will lead to the recovery in the oil price to around $50 per barrel, which in our opinion is the average sort of long-term marginal production cost. We think that is a very adequate level of the oil price for the sector, and I will try to show you the reasons for that over the next few slides. And we expect that that level will be reached by the end of this year, and we use that as a benchmark for our projections for the next year as well. Let me start by showing you this chart here, which in our view, sort of in my experience, I view that as a sign of health of the oil sector. It shows the one-year contango backwardation in one-year futures. So contango is when the futures prices are above the spot price, and that is the sign of oversupply in the market. That is a sign that it is profitable to put crude in storage. And you can see here on the right-hand side that during the period of the crisis this year, in March and April, traders could make up to 80% risk-free return by putting crude in storage. That is clearly not a productive activity, and that is reflective of the huge amount of oversupply that existed in the oil markets back in March and April. The situation has since normalized quite substantially, but we're still not fully normalized because there is still contango, which is still a sign of fundamental oversupply of the market. We know that the actions of OPEC Plus nations have led to the reduction of this oversupply, and I will talk a little bit about that later. But this chart shows me that we're still in a period of imbalance in the oil markets, and so it will take another few quarters for this market to fully balance out. But if you look into the chart on the left-hand side, we do expect that at some point this current contango will go into the backwardation. So that's when the futures price will be less than the current spot price. That will encourage the crude inventories to normalize further.
Alex,
as it will become, yes. Yes,
apologies again for interrupting your presentation, but we're getting quite a lot of feedback that your volume is still quite low. I don't know whether you could perhaps maybe adjust closer to the speakers or adjust the volume to the very maximum.
Yes, I will try to, maybe is that better now?
This is better. Okay, this is much better. I think the mouthpiece was much closer to your mouth.
Okay, all right. Well, thank you. Thank you for that comment. I will try to keep it here and keep the volume higher. So if there are still problems, please let me know. So hopefully it'll be better from now. So what I was trying to say here is that we do believe that at some point over the next couple of quarters, the contango will go into the backwardation, which will continue to incentivize the crude to start moving back out of storage. And that will start being a sign of the improved balance in the fundamental oil supply and demand. So if we look into this forecast from the Energy Information Agency of the US Department of Energy, they're forecasting that starting from the fourth quarter of 2020, the demand growth will start exceeding non-OPEC supply growth, which historically has been very positive for the oil price. So let's spend a minute looking into this chart. So the red columns, they show the demand growth year on year, and the gray columns, they show the growth in non-OPEC supply. And so in situations when the growth in non-OPEC supply exceeds the demand growth, it is during those occasions that we have seen historically big collapses in the oil prices. We have seen that in 2008, and we have seen that in 2014 as well. And we have also seen it in the beginning of 2020. At this point in time, clearly we had a massive demand destruction with the non-OPEC supply even growing in the first quarter, but then declining in the second quarter, but not nearly enough to offset the decline in demand. So we will probably see the same situation in the third quarter of this year, when the demand growth will, or demand decline rather, will exceed the reduction in non-OPEC supply. But starting from the fourth quarter of this year, the situation will inverse, and that is because of these ongoing actions by the OPEC Plus nations to control their production, and also the effective reduction in supply from many other countries which are not participants in the OPEC Plus deal, but which clearly saw an adjustment to their production plans as a result of lower oil prices. And then you can see how the situation will reverse again into the 2021 with a substantial increase in demand following the demand recovery after the end of the lockdowns, but the supply only increasing more gradually, and the situation balancing out then near the fourth quarter of 2021. So I think the message here is that over the next couple of quarters, we will see quite a significant imbalance in favor of higher oil prices. And that should be supportive for this recovery thesis that we're talking about now. On this chart on the left-hand side, you see the changes in inventory, and that's inverted, I have to note. So with the black line going down, that is reflective of the inventories going up, and the black line going down, showing the inventory level going down. And you can see that historically, again, there's been a good correlation between the reduction in inventories and the increases in the oil price. And on the chart on the right-hand side, you can see the refinery utilization rates at independent refineries at Shandong. Shandong province in China is a marginal, effectively, source of refined products. The independent refineries there, they tend to have very volatile utilization rates, reflecting the changes in supply and demand in China. And China was the first to go into lockdown in February this year. And you see what the effect that had on the utilization rates for the Shandong refineries. But China was also the first country to go out of the lockdown. And so what we can see here on this chart is that the demand now in China for refined products has fully recovered. And if we look into the similar statistics from other countries who were later to go in and out of the lockdown, we broadly seeing the same picture, with the demand for key oil products having more or less fully recovered to pre-lockdown levels. In some cases, they're even higher than they were pre-lockdown levels, with the exception of jet fuel, which remains probably at around the 50% demand right now. So I did mention that we expect the oil prices to recover to around $50 per barrel. So I want to show you a couple of charts to support this argument. First of all, just to say that, in our opinion, the short-run marginal production cost globally is around $35 per barrel. That's why we've been very skeptical when the oil prices dropped below $20 per barrel. We did not think that that was sustainable, and we did not think so because of this chart. Because in order to maintain your production on a short-run basis, pretty much every oil company globally needs to spend around $35 per barrel, and that includes OPEX and CAPEX. And we can see we have split here these charts into super majors, Chinese oil companies and Latin American oil companies, and all of them show approximately the same statistics of around $35 per barrel. And also they show that the costs have actually been declining, and so we need to incorporate that when looking into the cost structure for the next cycle. But if you look into the total cost, yes, this is just the short-run cost. So they exclude this is just basically maintenance costs. They exclude the long-term investments. They exclude the netback costs of transportation, export duties, taxes. Anything of that kind is not included in this picture. So if you include everything, so all types of costs, including the reserve replacement costs, then, and look at it over the last cycle for the last 5 years, the average oil price was around $57 per barrel. And if you look into this chart, you will see that very few companies actually were able to generate positive free cash flow under $57 per barrel. And that is mostly because of very high reserve replacement costs for the majority of the oil companies globally, with the exception of the Russian companies. So in Russia, the reserve replacement costs are very low, and that's why the Russian oil companies were able to generate positive free cash flow, assuming 100% reserve replacement rates. But in most other places around the world, the reserve replacement costs were so high that if the oil companies were to try to replace 100% of their production, their free cash flow would turn negative. And so that's why what we have seen over the last cycle is that with the $57 oil price, the oil companies were actually not replacing 100% of their reserves. Most of them were replacing less, and they were generating their free cash flow by running down the reserves. But that $57 per barrel over the last cycle reflects its relatively high production costs that I showed previously. So going further into the next 5 years, we think that they will reflect lower production and operating costs. There is certainly a deflationary trend in the production costs in the global oil sector. And so we suspect that $50 per barrel will probably be an adequate average oil price for the next 5 years. And that's the level that we expect the oil price will get to by the end of this year, because of this combination of reducing inventories, recovering demand, and continuing high compliance with the OPEC plus levels. So on the downstream, just a couple of charts to show what's going on with some of the key oil products. And these charts, they essentially have the same structure. So the red line shows the crack spreads up until the dotted line is the actual. Then there is a futures price currently. The black line shows the futures price as it was a year ago, and the gray line shows the futures price as it was 6 months ago. So on this one chart, you can see the situation as it was in the past, the current view of the future, and how that view has changed. So what is interesting, I think if we look into the diesel first, that is really the weakest point now in the oil products market, with the diesel crack spreads at historically low levels. And that's, I think, reflective at the moment. It's probably driven by Europe, the way we see it. And that is reflective of the high level of diesel storage in Europe, a situation that was caused by particularly European farmers storing diesel ahead of the harvest season.
Yes.
So that is now over. And so we expect that that will result in the recovery in the diesel over the next a few months. But you can see that the diesel crack spreads is now at the biggest difference there between what we see now, a record low diesel crack spreads, and what the expectations were a year ago. The gasoline prices have, or gasoline crack spreads have essentially fully recovered.
I'll bring it back to you now.
But
sorry.
What is in the bottom two charts is those two charts show that there's really now a shortage of heavier crudes and shortage of heavy fuel oil. The current crack spreads on fuel oil is significantly lower compared, or significantly better, I would say, compared to what the expectation was a year ago. And that is reflective of the fact that with the reduction in global oil output, it is the heavier crudes that were most disproportionately affected. And that also has caused now a premium pricing for some of the heavier and sour crudes that are sought after by the refineries globally. And that's what you can see here also with the Urals Brent differentials, which shows that the Urals is now trading, or has been trading in the last quarter, at some premium to the Brent, reflective of the undersupply, I would say, of the heavy blends. And that you can actually see also on the Nigerian crude. So when you look into the Bonilite differentials historically, that's a very high quality crude, has been trading at a premium to Brent, but then it went into a discount and now also trading at maybe a small discount to Brent, reflective of the fact that I said earlier, there is an oversupply, I think, of the lighter crudes and the undersupply of the heavy crudes. And that situation will normalize only when the oil prices recover, probably towards around $50 per barrel. So let me spend maybe the next few minutes just talking more specifically about Nigerian situation. So I did mention that we expect the continuing high levels of compliance with the OPEC Plus agreement. Nigeria was one of the countries that did not show the 100% compliance, at least according to OPEC Partially that is because of the differences in accounting for condensate. There was a joint ministerial monitoring committee meeting yesterday of OPEC and OPEC Plus nations. And one of the conclusions from that meeting was that they're not changing their current production quotas, but they do expect that those countries who have underperformed on their quotas will need to catch up over the next few months. And specifically for Nigeria, I think the target was set to compensate for the 300,000 barrels per day of overproduction. That's may impact the production of Nigerian oil over the next few months. The longer-term outlook for the Nigerian oil output for us is negative. I don't think we are saying anything new here. This chart here comes from Wood Mackenzie, and you can see the key issue here, the way we see it, is that the deep water production is declining because of the expiration of the mostly historical production sharing contracts and agreements. And the existing fiscal uncertainty. A lot of that can be addressed by this petroleum industry bill that a lot of people have mentioned, and I assume will be discussed during this webinar by the next speakers, but also the fact that Nigerian oil production has a relatively high cost structure globally, and also some other geopolitical considerations. The petroleum industry bill has been in the making for a generation. It was published officially on Friday, so we had a chance to review it, and it will, I think, be extremely important in the way that it addresses several legacy issues within the energy value chain, and will incentivize these investments going forward. The fiscal terms are clearly key here, and our quick analysis of the changes that the petroleum industry bill will bring shows that as far as the offshore is concerned, the offshore fiscal terms will become better compared to the previous regime, and we actually believe that they will be relatively attractive when you look at it on a global basis. At the same time, there are issues with onshore, and the onshore licenses will, in our opinion, will not be very attractive for newcomers, although the majority of that will be operated by NPDC anyway, so will not really impact that much the onshore output. And the last thing that I want to say on that bill is clearly the gas situation, and that was mentioned earlier as well. With the petroleum industry bill puts a great focus on incentivizing new investments in the gas sector in Nigeria, but there are many issues along the value chain. So it's not just the upstream that is affected; it's also midstream, so the infrastructure, and also the power and the payment situation there with the receivables, etc. That also, I think, will need to be addressed by the industry so that the gas investments can continue. So with that, I think I've extended a little bit my time slot. So thank you very much for your attention, and I'll be happy to answer any questions.
Thank you very much for that great presentation, Alex. I mean, there's so much to unpack there. We're just going to perhaps have time for about 5 minutes to take a couple of questions that have been asked on your presentation. And I would also ask you, because a few people were still struggling with the volume, to perhaps try and adjust it again as we go into the Q&A. So perhaps the first question from the floor virtually today is around the oil price and the oil price recovery. This person says your projection for price recovery did not consider the possibility of a second wave of COVID-19. How long do you think it will take to get the crude oil price to recover to pre-COVID levels? I would also mention that in your presentation, you projected $50 a barrel for the average oil price over the next 5 years. So perhaps you can also answer the question in light of what if there's a second major global wave of COVID-19? Thank you.
Yeah, sure. I mean, thank you very much for these questions. So there are a couple of things to consider. First of all, that the price is always a reflection of both supply and demand. And the second issue is the issue of the organic decline rates. So let me start with the second point first. The oil industry has this beautiful feedback loop into the oil price because of the organic decline rates. So any oil well globally declines if you do nothing with it. If you, in the absence of new investments, oil production globally declines at a rate of approximately, I would say, 12 to 14% per annum. I think our average estimate for the decline rate in Nigeria, for example, is around 15%. We also do a lot of work on countries like Russia, where we estimate organic decline rate is around 15% as well. But there are some places around the world, like Brazil, which declines at around maybe 10%. Saudi Arabia also declines at lower rates as well. But on average, I think for the world, the decline rate is probably around 12 to 14%. So the oil output declines in the absence of new investments, and the new investments are clearly deteriorating as the oil price is low. So there will be a very strong response from the production side just because of the low oil price. You don't even need to have any sort of long-lasting type OPEC plus type agreements, because if the oil price were to stay low, the industry supply side will adjust. I think the need for us to have the OPEC plus agreement is because the demand adjustment was so quick. And so there was a necessity to coordinate the response by the producers as well. And so that's why I think OPEC Plus was so helpful in the last few months. But its importance will clearly become less significant as we go forwards and as the markets recovers or becomes balanced again. So there is an issue of this organic decline rates and the effect on the supply-demand balance. Now, if there is a second wave, then I would suspect that in the short term, the OPEC Plus will make its adjustments. And in this respect, we know this concept that we have introduced called OPEC put. What that means is that we actually have high confidence in the ability of OPEC plus nations to coordinate their supply response. We have already seen that in June, when they have delayed by 1 month their forecast production increase from July. It was delayed by 1 month to August. And I expect that now we can see the next delay, which is currently expected an increase of 2 million barrels per day in output from January. If the recovery fails to continue because of the second wave or for any other reason, then I suspect that OPEC plus nations will delay that 2 million barrel per day increase by a few months. As a matter of fact, Wall Street Journal reported last week that Saudi Arabia has already offered to delay that 2 million barrel per day increase until April. And so we do believe that action will be taken rather swiftly. I would also note one comment that came yesterday from this JMC meeting. It was voiced by the Russian energy minister, actually, Novak, who said that in his estimate, the current disbalance in the market, so the supply shortage, is around 1 million barrels per day. That is a relatively low number. If you go back 2 months ago, then the expectation was that the disbalance or the supply shortage in October, November this year will be closer to 3 million barrels per day. So there is clearly already been an effect on the supply deficit and the pace of the reduction in inventories. So yes, there is deficit right now. Yes, inventories are being reduced, but they're being reduced at a smaller pace than what was envisaged only a couple of months ago. So that perhaps points towards the potential delay in this adjustment to the production levels of the OPEC plus nations, and that 2 million barrel per day hike in January could be delayed until April, at least in my opinion, which will support the recovery in the oil price, even in the situation that the demand is recovering slower.
Thank you very much, Alex. And there's just one more question for you, which is around the high production costs in Nigeria. How do you marry this with the fact that Nigeria is also has struggled historically to meet its production cut quota under the OPEC arrangements?
Yeah, I think that the high cost structure, we attribute that to the relatively high local content requirements that makes Nigeria resilient to cost deflation. And also, there is certainly a high share of offshore costs that is denominated in dollars, so it did not really have a benefit of the local currency devaluation. As far as the requirement to increase the compliance level with the OPEC Plus deal, as I mentioned earlier, it is somewhat debatable point because of the differences in accounting for crude and gas condensate. But if we take this message from yesterday's joint ministerial monitoring committee meeting of the OPEC Plus nations as a guide, then we would expect that Nigeria will have to increase the amount of oil production cuts. And the specific number that was mentioned yesterday was 300,000 barrels per day that will have to be met by the end of this year, so to increase the overall compliance level of the OPEC Plus nation. So I would expect that maybe there will be some adjustments in the overall, country-specific production level.
If you don't mind me just throwing in one more question as we come to the end of the Q&A session. There's a question here. Someone asks whether, considering all that is going on, I guess with the oil price and the global environment, is it a good time to fund a marginal field for 5 to 7 years without taking a hedge?
No, from, you're asking an oil analyst, from my standpoint, yes, I'm actually quite optimistic in the recovery in the oil price, as I mentioned earlier. So it is a good time to actually buy the oil assets, in my opinion. The problem that a lot of companies and a lot of investors are facing these days is the availability of funding, and for a lot of issues relating to maybe overall sort of economic issues in certain countries, the issues surrounding the climate change agenda, and certain funds and certain banks already highlighted they're not going to support the investments or new investments in the oil and gas sector. So there are issues like that that need to be considered. But fundamentally, from the perspective of an oil analyst and the oil price, we do think that the oil price will recover. We see a lot of evidence for that. Certainly the cost evidence shows that the current level of the oil price is below what we see is the long-run marginal production cost level. So that means it's a good time to start investment in the oil sector, and hopefully over the next 5 years, as I said, we will see the average oil price, which will be above the current spot price.
All right, thank you very much for that. Alex, thank you for bringing that global perspective to the discussion today. Thanks for your time, grateful to have you. And apologies that we couldn't take all the questions directed to Alex, but Alex, if you don't mind, we will send you some of these after the presentation. Perhaps you could help us answer them very, very briefly.
Sure, and thank you very much for having me.
Thank you. Thanks again. Thank you very much. Okay, ladies and gentlemen, we're moving on now in the discussion, and it gives me great pleasure to introduce Mrs. Audrey Jo Ezigbo, who is the president of the Nigeria Gas Association. I'm going to be having a very brief fireside chat with her. She's also executive director and co-founder of Falcon Corporation, a leading indigenous gas producer, gas developer, and gas operator. So we're very welcome, Mrs. Jo Ezigbo. Great to have you. Great to be chatting to you again.
Hi, Rolake. Good morning. My pleasure to be here.
Okay, so great. We have about 10 minutes to have this chat. And the first question I have for you perhaps is around the current pandemic environment. It's been about 7 months since we went on lockdown over the pandemic. What do you think, from your perspective, the biggest impact has been on the local gas industry?
Right, thank you, Rolake. So yes, it has been a very interesting time for the domestic gas industry. As you know, there is a very strong relationship between the oil and the gas sectors in Nigeria. And what this has meant has been that as much as the oil sector has been dealing with the twin shocks, then the gas sector has felt the impact as well, even though maybe a bit more protected in a sense. But certainly we've seen logistics constraints. So both in terms of not being able to access project sites, in terms of not being able to get manpower and resources out to projects. So repairs, maintenance work that couldn't happen, operations that had to be suspended. We've seen revenues decimated. So some planned projects put on hold, and even ongoing projects that had to be stopped. And of course, when you think about that sector and you think about travel restrictions and all that, we're now talking about the impact both on the operators as well as the end customers. And so both from a supply and a demand perspective, the industry was constrained. We've seen people having to renegotiate contracts. Like we say, we've been operating kind of a global force majeure. I mean, who do you blame for a pandemic, right? And so people have had to go renegotiate their terms with their financiers and so on and so forth. I think it's just been interesting times, particularly for those who are in the support ancillary services space. We have seen a lot of closures. People have been, I mean, when you don't have any operating cash flow for months on end, and of course, beyond the pandemic, you know, it's not just the oil prices, then the global, the macro, as it impacts on any other business has been a problem as well. So we've literally seen some companies shut down, let go of staff. And I mean, it's just interesting. But I think beyond the constraints, it's also good to look at what have been the positive developments in this time. So it's given all of us room to kind of go back and rethink our business models, our operating strategies. Is giving us a chance to look at how do we create better partnerships and synergies. So people are now talking about shared resources, about co-location of facilities. And then of course, everybody has suddenly, you know, well, not suddenly per se, but really the focus on seeing how we build a more resilient domestic gas market. I mean, it's staring us right in the face because that would have protected us a bit more. So, I mean, I think it's just interesting times, but certainly everybody's looking for how recovery happens and in a more resilient manner because you never know what is waiting up ahead. Yeah.
Thank you. And that's quite a laundry list of, of challenges, but it's good to hear that the positives is almost just as long. So if we look at some of the key priorities for the gas sector, you know, the GMD and NNPC have talked about one of that being delivering the gas blueprint for the AKK project, you know, growing domestic utilization to around 5 billion scuffs by 2022, developing 5 gigawatts of power generation, partnering and collaborating. So I wanted to ask you, which one of these, initiatives excites you the most and why, from your perspective?
Right. I think it would be around partnerships. And the reason for this is, in my view, that's what underpins the success of any other one of the objectives. So I give you an instance. So if you take the AKK project, so now that's kind of locked in terms of the project contractors, in terms of the funding. But you see, a pipeline doesn't just stand in itself. And even if you flow molecules into the pipeline, there has to be an outflow at the other end. What this means is that the true success of the AKK is going to be contingent on having offtake markets that develop along that pathway. And for that to happen, you're going to need some people who come in with distribution infrastructure, processing infrastructure. You're going to need people who are willing to set up gas-based industries and things to take or to offtake gas along the AKK route. And that's going to come from private sector. So when you look at the issue of trying to generate up to 5 gigawatts of power, I mean, that's, again, in my view, private sector driven. When you look at trying to increase in-country gas utilization, again, where are those projects coming from? It's going to be private sector. And so what it means is that when the government is speaking to a heightened imperative for partnerships, for collaborations, then it speaks to an understanding that it's a private sector play in partnership with government. And it means then that the expectation is that as they're thinking that through, they're looking for workable frameworks to incentivize partnerships in that sector. So for me, that's the one signal to say, look, we understand that this is going to happen through the private sector and we're willing to open that up. You know, I think one of the key things is trying to achieve this, the gas infrastructure blueprint. And that, you know, has not been, if we look at how far we've come with the same narrative around that, being able to action it now, clearly, the government doesn't have the resources. The private sector is looking for the opportunities and the landscape to enable that. So I think it's a win-win if we can make it work. Yeah, so for me, that's the most exciting, yes.
Fantastic. And I love the way you answered that. The reality is all of these things cannot happen if we don't all collaborate. And speaking of resources, specifically financial resources, as you know, part of the challenge for gas sector operators has been long-term sources of capital to finance this large-scale infrastructure projects, because many of these contracts are long-tenured. How do you see the capital markets helping businesses like Falcon meet that requirement for their projects? Is this something you're looking at tapping into, or have you tapped into it as an operator?
Yeah, so I think that clearly this is one of the ways to go, because from the point of view of the commercial banks, for instance, there is no way when you look at the typical gas project, for the kind of financing that is required, for the kind of foreign exchange exposure that is involved, for the kind of tenured facilities that will fit the businesses that we do, the models that we have. Usually you can't get that kind of financing unless it's a consortium type financing within the commercial banks, and those arrangements are not as common as it may otherwise should have been. So yes, we've seen developments, people are going to the bond market, we've seen private equity funding, but certainly there has to be, given that there's constraints on global capital, there has to be a way that internally we create that framework to allow investors to access funding, especially for gas projects. So yes, I do think that, when you look at the capital markets, there is, the opportunity is there. Okay, it's now going to be in terms of the structuring, in terms of how many people are willing to come to the table. And I think one key thing is the understanding. So what excites me more recently is seeing more depth in terms of, when I look at financial institutions, their understandings about the energy space, because that's very critical. If you don't understand that space, if you don't understand the terrain of gas, it's hard for you to package the funding that works. So I'm particularly happy to see what NSD is doing with this webinar, because it's opening up that dialogue more. You asked me whether we've tapped into that opportunity. I know that we have had the conversation a few years back. It didn't crystallize, but I also know that there has been a lot of movement in terms of what the opportunities are on the various levels within the markets that people can assess. So it's a conversation I'm sure many of us are happy to come back to. It will certainly be better for the industry at this point in time. Yeah, thanks, Rolake.
Thank you very much, Ms. Joyce. I have one more question for you, and I hope we will see the day when we'll have a gas-focused, primarily more gas-focused businesses listed on the NSE. But yes, finally, I mean, there's a sense in which current investments in the current environment, the events in Nigeria suggest that real change in an industry, in an economy, in a country has to be led organically. If we relate this to the gas sector, who do you really think holds the key to change, whether it's from a regulatory perspective, from a policy, just in terms of the business environment, for really moving this industry forward? The operators, the government, and why?
So I really think it's both, Rolake. It gets a bit, in my view, unfair when we try to lump the responsibility on any one party. So yes, government has this role to play in terms of thinking through the policy, the regulatory framework, the legislative framework that could work, that could incentivize new investments, support ongoing investments and all that. But the private sector also has a role to play. I think that the challenge we face a lot of the time is trying to find that fine line where we're balancing the government's objectives with what the private sector wants. Now, in the Nigeria situation specifically, I can tell you that because we have such a huge infrastructure deficit, and because we don't have the capital to support it, we don't have as robust a market as is required to support. So there are just many things that constrain investments. So it's very easy to argue the narrative that we should be looking at what private sector wants, because we need to bring more of them to the fore. But the government is also looking at a more long-term sustainable framework that is, in the interest of the general country. And those objectives are not divergent. I actually think that there are two things that are on the table in the minds of both governments and the operators. One is, how do we build a more robust, resilient domestic gas market? Everybody wants that, because when that happens, everybody's happy. And the second thing is, how do we create an industry that works, an industry that is trusted, an industry that is stable, whether it is from the policy point, the regulatory point, anything. I mean, all those different metrics by which you say an investment landscape makes sense. Everybody's looking for that. And we have to find that midpoint that works. So certainly we need to bring investments to the table. And certainly we need to not have a monopolistic situation. We need to just be able to manage that space. But at the same time, those of us who are the investors, it's important we try to see it from the eyes of the government. And then the onus is on both parties to find that win-win, that midpoint that makes sense, to find models whereby perhaps in the shorter term, there is a focus that seems to benefit the investors more because we want to bring more of them to the table. But over the long term, we have to balance it out, keeping national interests as a priority. I hope that answers your question. I won't put the blame on anyone. I think we all have to bring our hands together, bring our ideas together to make the industry work and to make the nation work. Thanks.
Yes, indeed. Thank you. Very, very wise words from you, Mrs. Joezigbo. And you've been a pioneer in your own right. It must be mentioned that you're the first female president of the Nigeria Gas Association. We thank you so much for giving of your time to this discussion, and we look forward to collaborating with you going forward. Thank you very much, ma'am.
Thank you so much, Rolake. God bless.
Thank you. So, ladies and gentlemen, thank you for staying with us and listening. We're now going to head into the first of our two panel discussions for today. And we're going to be having a discussion on the impact of COVID-19 and oil price volatility on operations. So it gives me great pleasure to introduce the distinguished panelists. First up, we have Mr. Emeka Onwuka, who is an executive director and CFO at Seplat. Then we have Dr. Lai Fatuna, the CEO of Niger Delta Exploration and Production, NDEP. And we have Mr. Olivier Moussa, who is the Chief Investment Officer for Global Energy at the International Finance Corporation. We then have Mr. Chuka Eseka, who is the President, the Association of Issuing Houses of Nigeria, as well as CEO of Vetiva. And finally, last but not least, Mr. Olumide Ogunfowora, who is the co-founder and managing director of Argentile Capital Partners. So if I would kindly ask the panelists to please go on their videos so the participants and audience can see you all. So the structure of this is that we're going to have very, very brief high-level opening statements from each of the panelists for a maximum of 3 minutes each, talking about the impact of the current environment on their business, after which I will ask them a few questions, and then we will have Ms. Amy Jadasimi come and give us some of her own remarks before we open up the discussion to the audience Q&A. So please do remember to put your questions in the Q&A chat box. So moving on, I'm going to ask Mr. Emeka Onwuka of Seplat to please give us his opening statement. Thank you. Mr. Emeka, over to you.
Thank you, Rolake, and good morning all. Talking about the impact of COVID on our business, none of the large corporates and nobody actually predicted the health crisis that we just gone through in the past few months, completely blindsided. And the implication is that being unprepared, we all face the initial shock of looking at the impact on our businesses. For us in oil and gas Seplat, the major impact was on our revenue and also threatening our operations because of the response to the crisis in terms of restriction of mobility and all that. However, you know that the oil and gas industry being very, very physical over the years, there has been major emphasis on health and safety. Clearly, there are already existing protocols, to safeguard the health of workers at the fields. And what we just did was to extend that protocol, to deal with the COVID, which was a very unique situation. And we were able to sustain our operations, and all the field operations were sustained during this period. Pull back a bit. Seplat is a leading indigenous energy producer in Nigeria, focused on the growth of oil and gas business in the country. And beyond the upstream business that we are still involved in, we are also driving the growth of the domestic gas market to power the economy, particularly because of the energy shortfall in terms of electricity. Currently supplying over 30% of the domestic gas requirements of the GenCos. What that also helped us to do is that the impact was mitigated by the fact that our domestic supply of gas actually cushioned the impact of the drop in revenue arising from the global, the crude oil price drop. So basically, the crisis is not over yet, but I believe that we have, everyone has tried to understand the extent of the crisis, and we are responding in a more structured manner, and we are restarting our operations and reverting back to our pre-COVID level of operations.
Thank you very much for those opening remarks, Mr. Onwuka. I'm now going to ask our next speaker, Dr. Fasana of NDEP, to give his opening remarks. Dr. Fasana.
Good morning. Rolake, thank you very much, and sincere appreciations to the Nigerian Stock Exchange for providing this platform for all of us to vent our ideas. I think so much has been said about the pandemic, but I think to a large extent, for us as a company, I would probably want to say that it has its positive sides. We're all working very smarter. We are working healthier, and I think we are working safer by and large. Otherwise, the impact of the COVID, at least on numbers and people and all of that things would have been much more different than we're all recounting now. As a company playing in the energy space, I think the pandemic had encouraged us, and it has inspired us to bring to the fore the need to interrogate more and frequently the subject of Nigeria's energy security and independence. In addition, it has further heightened the very certain difficulties of surviving under OPEC membership, the constraints it brings to all Nigerian small independent operators. It is testing the resilience of our category of E&P players, the Nigerian independent producers, and the very, very strategic roles that we have played, that we will continue to play as NNPC's reliable national strategic partner. I think in all these, it is very important to say that those of us who will survive, and I'm very sure that literally all of us will survive, we're going to be much stronger. And I think I would leave how and ways and means of getting there to the question and answer session. Thank you very much.
Thank you very much, sir, for those opening words. So Olivier, your opening remarks, please.
Thank you, Rolake, and Your Excellency, ladies and gentlemen. Thank you very much for hearing us. I think as a quick introduction, IFC is the private investment arm of the World Bank. We have about $60 billion in management, and we invest about $1 billion a year in Nigeria alone. And this is across all sectors, although energy represents less than 15% of this. It is quite interesting to see how over the past 5 years, as the oil price has started to decline on an average basis, we have seen our investments also decline, showing that actually international investments in the country have declined as a whole. And this is a representation of a country where 90%, although it's oil and gas only represents about 10% of GDP, 90% of exports is related to oil and gas, and over 50% of government revenue is oil and gas. So if we put that into the context of the COVID issue, we essentially came to a breaking point where for a long time we were hoping for the best and trying to prepare for the worst, but probably not enough. So what we have seen is there's definitely a big letdown on the government revenue side, a lot of private sector being affected, and that's directly, but then you have a double hit of COVID, where you have a demand shock on the manufacturing, industrial, and electricity side. So we already had a number of utilities which were weakened previously by an increase of cheaper renewable energy, industrial companies trying to go off grid, and it basically all came crashing down very quickly. Now, this is a real issue for us as a development bank because access to energy is the foundation of any economy. And when you look at a health crisis, if you want to have access to clean water, you need access to cheap energy. And if you need to access to also to hospital services, you need again access to clean energy. So we are now into the rebuilding phase. From an international perspective, we try, you will hear more and more that we need to rebuild better. And unfortunately, for a lot of international investors, rebuild better means rebuild green. And many times they say, well, forget about oil, this is not green. Forget about gas, this is not green. And we fundamentally disagree, because gas, especially in Nigeria, is a huge opportunity to industrialize the country, to create more jobs and to green the economy much faster. As an example, in Nigeria, like the people only use, on average, the population lose 30% less LPG than the average of Africa, of the whole continent. And this is quite a big issue for us, because it leads to essentially using diesel or using wood, which leads to deforestation, another big issue for us. So the opportunity that we have today is actually to look at targeted investment to expand access and security of supply. But also it's an opportunity to take out subsidies in the system, which have been a real issue for the people. So how to make sure that we give access to energy to the poor whilst charging fairly to the rest of the sector. And it will make it cheaper as well for government to embark into the very necessary reforms that need to happen in order to create the level playing field and the fair playing field that Mrs. Joes-Gibo was talking about. So I'll leave it at that for the rest of the discussion.
Thank you very much, Olivier. So I'm now going to call on Mr. Chuka Iseka to give his opening remarks. Sir, you're on mute. Mr. Iseka, you're on mute.
Thank you, Rolake, and thanks to the Nigerian Stock Exchange for giving me the opportunity to participate in this forum. Just to build on what has been said, I think it's best to look at the impact of the pandemic from a market-wide perspective. That means how it has impacted on we operators in Nigerian capital markets. So what was the major impact of the pandemic? It changed the underlying macroeconomic fundamentals, and that filtered onto investor sentiments, and that filtered onto the performance in the stock market. We know the narrative on what happened to the demand for oil, the impact on the oil price. We know the impact on government revenues. We saw the pass-through in the Nigerian capital market. We saw investors seeking to exit the market. We saw uncertainty with domestic investors also initially. So the market fell to its lowest point in April. Now, there are also uncertainties as to the availability or stability on dollar liquidity, so these investors couldn't get out, which made the situation a bit worse. Now, however, as we moved into May, investors started bargain hunting, and the market started recovering, and investors that couldn't take out their money started getting back to the market. But the market now did some level of recovery. Now, remember, we also had a lockdown, and that lockdown had an impact on economic activities. And by the time Q2 results started coming out, results were underwhelming, and again, the market went back into negative territory. Subsequent actions by the CBN in cutting the NNPC rate brought a lot more liquidity back into the market, and the market is now in positive territory. But what is the learning point? Our capital market has to be made more resilient, and the key to making our capital market more resilient is improving our level of domestic savings, so that we're more insulated from the vagaries of the global market. And many of the things that we're going to talk about in this session plays a big role. A lot of the economy has to be represented in the market for the market to be more resilient. There are a number of questions. We operators, we've survived because of favorable conditions in the fixed income market, either trading fixed income or underwriting or selling bond instruments. That's what has sustained the market and spillover of advisory opportunities pre-pandemic. But you find out that yields in the money market are so low, and there's still not enough liquidity in the capital markets. Why? So I think this is an excellent opportunity for we as operators and also investors to look beyond fixed income. No economy grows on putting money in short-term paper. We need risk capital to grow the economy. And this is an opportunity for us to structure instruments and for investors to look at other avenues of investment outlets that can give you a good return, and also track inflation. Everybody's getting poor when risk-free rates are below inflation rates. So we need to look more into infrastructure funds and other type of investment. And this is an opportunity, a wake-up call for the market and for investors that we really need to look at the structure of the Nigerian capital market and make it more resilient. Thank you.
Thank you very much for that, Mr. Iseka. And finally, Mr. Ogunforowa, your opening statements.
Okay, thank you, Rolake. Good afternoon, everybody. I think a lot of has been said by different participants here. Well, I'd just like to focus on a couple of key theses or points for me. Whilst the forecast may differ in terms of the different sources and how they view forecasts, there's a broad consensus that certainly it will be challenging. The industry is going to face significant challenges over the next couple of years as it recovers from the pandemic. And this is against the backdrop of a very, I guess, a movement that is not going to turn back, which is really focusing on clean energy, ESG, and things of that nature. In fact, and indeed, there is more discussion these days with respect to when are we getting to peak oil? Where is the industry going to be in 10 or 20 years' time? And is this a dying industry? So there's a lot of discussions around things of this nature that will continue to pose challenges to the industry players. But I think fundamentally, you would also expect changes to the entire industry structure, particularly when you hold that in light of global geopolitical factors as well as regional geopolitical drivers. But I think over the long, medium to long run, you're likely to see, oil prices in the $40 to $60 range. Again, given this tempering of demand with the possibility of excess supply, what we've seen in the market right now, you can see the industry. There's been different companies have about to basically reevaluate their assets. There's been significant impairments of assets by majors all over the world, independents all over the world, and even the Nigerian players. As a lot of assets, when you take a look at them, especially the non-conventional or deep water assets, generally tend to need anywhere in excess of about $60 per barrel to be viable. We've seen a focus on liquidity. The Nigerian sector has been especially active, as we all know. There's been a concerted effort led by the central bank directives, which has actually ensured that the banking sector and their clients work together to address the solutions over this period. Of course, you've seen with respect to that suspension of dividends, share buybacks, and people that have the ability to draw credit. For example, the international companies, they have actually drawn down that credit. I think within the first 1 or 2 months of the pandemic, the excess credit lines that were drawn down, were probably in excess of about $40 billion, depending on the sector. So supply of capital, unfortunately, we remain challenged. We remain challenged in the short to medium term from our perspective. And you only have to look at what has been happening in the sector globally. When you compare the oil and gas sector, the performance of the oil and gas sector to other sectors, oil and gas sectors have actually underperformed the other sectors. The S&P 500 is a clear example when you take a look at it. And just to take one of the marquee companies as an example, ExxonMobil basically has dropped down from about $500 billion of equity market capitalization to under $140 today, $140 billion today. And it has been removed from the Dow Jones Industrial Average after having been there for over 100 years. But in perspective, when you look at the energy, the broader energy field, a company like NextExtra, which is focused on solar and wind, has actually surpassed ExxonMobil in terms of market capitalization. Now, this is not to paint a doomsday scenario. I think it's just to accentuate the challenges that are that we are seeing in the market. When you bring it back down to Nigeria, certainly there is a lot of focus, a lot of positive actions by the industry players to get through this challenging period. Gas, as been said, remains a very bright focus and one that Nigeria can definitely leverage itself on. And then when you look at things that has been done, there's the focus on liquidity management, debt restructuring, which I think has been largely successful in bringing people through this period. And on the opportunity side, when you look at it, there are good progress on equity discussions, injections. You see a lot of however, the focus has been really more on asset integrity, low risk development, liquidity, sort of selective M&A that you can see. And as we all know, there's been a lot of interest in the Nigerian marginal bid round, which is actually quite positive to have this sort of response and interest from the industry against the backdrop of these challenging times. And I think I'll just leave one last thing before I pause here, to just say that again, the opportunity for M&A is still very much there on a global level. Just yesterday, ConocoPhillips announced a share acquisition deal of Concho Resources, which is a shale oil player, for $10 billion. So which means that in essence, while these challenges are there in the short to medium term, I think it is when the fear factor is actually quite high that you actually have the most opportunity to be able to take advantage of the situation on the market. Thank you.
Thank you very much, Mr. Ogunfowora. So in the interest of time, I'm going to ask the panelists to please keep their responses short so that we can get another round of questions from everyone. So I'm just going to go back now to Mr. Onwuka of Seplat. You know, Seplat has obviously participated in capital markets following your dual listing, which is very well known across the market. So I wanted to get your thoughts on what companies like yourself should be looking at in terms of raising capital now, both from the debt and equity perspective, especially now that we have capital that is more selective. That's the number one. And then number two, are you concerned at all about industry or technological disruption in the sector, especially in light of the global energy shift? So if you could just please very briefly speak to those two questions. Thank you. So I would ask you to unmute your mic, please.
You're right about Seplat being listed on the London and the Nigerian market, and we're able to access equity capital over the years from the two markets, and we're supported by leading investors in the industry. However, like you heard earlier from other speakers, that the oil and gas industry has underperformed, clearly because of what had happened, the twin effect of the COVID and also the issues around Russia and Saudi Arabia in terms of controlling supply. So there's been an underperformance of these stocks, and the stocks are not trading, most of them are not trading at optimal level, both in Nigeria and in London. And as such, it may not be an attractive period for you to raise money by way of additional equity at this time. So it's not a very tenable option. However, there's still a lot of debt capital available to fund operations, particularly operations that are cost efficient. Today, because of the outlook in terms of crude oil prices, the big challenge is they play about cost of production. And for a company like us, we're already at the range that NNPC is aspiring other companies to be in terms of cost of production. So if a company has a good cost of production and also has a lot of liquidity on their balance sheet, they'll be able to continue to attract debt capital to fund operations. And that's the state of play in the oil and gas industry, and not just in Nigeria, but also other African countries as well. Technology is an issue, clearly driven by the need to reduce carbon footprint in the industry. And as such, we are also set up derivative units, and for most other oil and gas companies as well. They're looking at how to use technology to improve the operation and reduce the carbon footprint of the operations, and also in terms of efficiency to reduce your cost of production. So we are looking at that, and we are responding to that by making significant investment in innovation to ensure that we use technology in operations to reduce our cost. But one area that's very important that we talked about earlier today is the fact that investors have become very socially conscious, in saying that the appetite to invest in hydrocarbon because of the level of emission arising from hydrocarbons, is an issue for investors. And so most companies like ourselves have to take the renewable objectives very seriously. And we are currently also looking at that segment of the market, which is why we are very big in the midstream in terms of oil and gas. Gas being a transition energy at this stage, because we believe that our country, Nigeria, which is our focus, have our own climate issues. However, a major objective currently is to displace diesel as a source of power and electricity in the country. And that's why we are focused on midstream and gas as a bright area in terms of our investment today.
Yeah, thank you very much, sir. Very, very good and pertinent points. And Dr. Fasten, I'm going to come to you now. It's interesting because Mr. Holka was mentioning the fact that investors are more selective about investing in more cleaner sources of fuel. But, NDEP as a company has actually diversified across the hydrocarbons value chain, including in the refinery business, which I guess may have helped you stay resilient. And the question I have for you, are you seeing something that we're not, given the global shift away from hydrocarbons to cleaner fuels, and how has your business model helped you weather the current pandemic storm?
Thank you very much, Rolake. 3 years prior, we as a company, we commenced the journey of a corporate transformation from an E&P company that most of us are, to an integrated Nigerian energy company. And mark my word very carefully, we started the journey of transformation from an E&P company to an integrated Nigerian energy company. The first realization of the adventure was manifesting just at the onset of the pandemic. You might say our transformation journey, you might say luck was driving it, but I would rather say that foresight was the key thrust for such a very strategic change of focus. As of today, our newly built, fully fledged, independently owned and operated refinery, and I think it's the first of, and perhaps the only one of its type in Nigeria, is fully functioning and operating at licensed refining capacity. This refinery is located in Ogbele in Rivers State, funded by the company's equity and notably debt financing by the Bank of Industry, BOI. It's now fully licensed by the DPR. Trains 1 and 2 of the refinery, quietly to our delight, is now steadily on stream. And when you think in terms of the impact of these as providing a import substitution for Nigeria, then the foresight that the company took 3 years ago and the journey we have navigated for ourselves, then comes into play. So yes, indeed, for a company, you will say we are surviving, and I think we literally have survived on our own cash flow all throughout the hard times of the pandemic till today. I think we are set for a very most promising new year of accelerated recovery and substantial contribution into the Nigerian economy. Now, the most important thing here, which I would like to say, from all the lessons that we have learned as a company all through the pandemic, the president has left us healthier, much more nimble company, and in all aspects of our business health check. I think we are raring to go, beyond the pandemic. And but the most important message here is that irrespective of the thinking of the energy mix, we still have to think about our country first. And I think this is why I talked about our own energy and energy independence first, and energy security. And I think that is what should drive us primarily for a country of more than 200 million people. Energy security and independence is very, very, very key. And I think it's the focus that we must not run away from.
Thank you very much, Dr. Fastener. And I think there were a couple of comments around your audibility. So I would possibly ask you to have your mic, maybe move closer to your mic as we come back to the Q&A section later. I like what you said about resilience. Now, I think, Olivier, looking at it from what stakeholders like national oil companies can do, we know that NNPC has been a partner in JVs with private operators, and they often have their own funding obligations that they need to bring to the table. Given what has happened with many NOCs around the world, such as Aramco going to the markets, for instance, is this really a conceivable proposition for Nigeria? And what do you think the impact would be on an NNPC going to the capital markets to tap into alternative sources of funding?
Sure. Thanks for that. So, there's this say where, you should never waste a good crisis. And sometimes it's a good opportunity to take very harsh decisions. So we had actually discussed with a presidency, what about, privatization of NNPC? We're talking about 5 years ago now, or at best, maybe the privatization of NPDC, because it was, an operator with a large number of barrels it was running. And we talked, and it remained a discussion. And at the time, what we were using is the example of Ecopetrol, the Colombian national oil company, which had a really successful IPO back in 2007. When we look at Saudi Aramco, it was a tough privatization, where they were hoping to put only a part of the assets, but not all of the assets. I think there's some echo as I'm speaking.
May I kindly ask everybody who's not speaking to go on mute? Thank you.
Successful IPO back in 2007. Thank you.
Mr. Timothy Onaniwu, could you please go on mute, please? Thank you. Sorry, Olivier, please proceed.
Sorry about that. So it takes a while, right? I mean, what we have seen from Aramco, it takes about 3 years to do it. Once you have taken the decision until you get there. In the recent Aramco privatization, privatization is a big word, right? What we have seen is actually the local investors had to bear much more of a burden because the international markets was not that interested. The biggest issue that people had was around governance. Everybody talk about ESG, environmental, social governance, and we always forget about governance. As an international investors, I am worried about the environment, of course, but also what we have seen is what makes a bad investment sometimes is the governance aspect of it. So, which is why the local investors had to take a bigger bet on their own country to make it successful and to reach the valuation that Aramco wanted. So, would it make sense for NNPC to go into the privatization route if it was for the goal of indeed being able to carry its weight all throughout its assets and the future developments? Yes, it would. If you want NNPC to continue to remain the stalwart of Nigerian sovereign assets, probably less so, besides just doing a temporary injection of a lot of capital into the system, which will then go into government coffers, right? If you're going to do an IPO, you want that IPO for all the money to go into strengthening the company, which is going to benefit from that. So it is a question of what are going to be government priorities, but from an international investor's point of view, clearly, it is going to be much easier to attract capital if you know that your 55 or 45% partner is going to follow you in providing the money. Otherwise, as a banker or as an equity investor, if I know that for $1 invested, my partner is not going to put his other dollar, I'm going to need to be able to finance $2 on the back of $1 worth of assets, which makes the conversations much more difficult. Not impossible, but much more difficult. And maybe this is kind of where we see it in the power sector, where we have basically, when we look at the state of the disco companies, which went into a privatization route, and now are kind of stuck because there's a number of things that should have happened, which didn't happen. And again, going back to governance. So it is, it is definitely, from my point of view, we know about the future. We know about the future of renewable energy. And we know that international investors are taking the view that, oh, well, what's going to happen in 2040 when we reach peak oil? And that's governing the view. But if you are looking at something in a much closer term, 5 to 10 years, governance, governance, governance.
All right.
I hope it helps answer the question.
Yeah, no, great answer, Olivier. Thank you very much for that. And I'm going to bring in Mr. Eseka, because obviously we talked about, the JV partner on the government side seeking funding, but the operators, the 45% in most JVs, also have to tap into the markets. Do you think, in terms of the current spectrum of operators that we have, that there is a deep enough and broad understanding of the depth of the capital markets or the extent of opportunity that resides in there? In terms of funding instruments, and perhaps how does this align with the need for long-term sources of capital in the industry? Mr. Eseka.
Thank you very much. I think I'd like to first start by looking a closer look at the current structure of the oil and gas sector vis-a-vis the structure of listed entities in the Nigerian capital market. The oil and gas sector is dominated by government and the IOCs, like you know. And the IOCs do not rely on Nigeria for their funding. They have their own structures. And government participate mainly through JVs, and they rely on the budgetary process. The technicalities around the federation account dynamics do not allow government to come directly to the market as at now. And historically, they've moved on to PSCs to reduce the risk of government not being able to meet its obligations. Now, the implication of that is that there's been limited pass-through in terms of financing to the local capital markets. So the market has not had the opportunity to develop the competence and skill in financing those kind of transactions as we've done in other industries. But this has been changing from repeated marginal field rounds and divestment by IOCs. We've seen more indigenous participation in the sector. And for those companies that are able to demonstrate competence and able to put in place a good balance between the risk and reward, they've been able to access market. Oscar did say that over 400 billion has been raised in the capital market over a couple of years, and Seplat Owando have been beneficiaries. So there is depth in the market. If for the right projects, there is depth in the market. Now, from the discussion we've had on this table, clearly as we're moving to a fully deregulated environment in the downstream sector, there will be appetite for downstream transactions. Now, also in the oil and gas sector, in terms of financing the oil and gas value chain, there will be appetite for those kind of transactions. But looking at looking at the upstream assets. Now, I think globally, not all upstream projects do not necessarily lend themselves very well to public equity markets because of the riskiness perceived. And that's why in the more developed markets, you have structures like AIM and also the TXS in Canada for allowing more risk capital go to those key type of activities, especially for the smaller players. Most of the marginal field operators that got the license in the initial rounds couldn't access the public capital markets. They won't have met the requirements. They had to rely more on private capital to grow their business, grow their reserves. Then they can approach the capital market. So the bottom line is that for the right projects, the market has the capacity, the market has the debt. Though there is an arguable case as to how deep really is the market, because oil and gas transactions are large and they are long term. So that's a fair point. And like I said, as more transactions come into the market develops more competence, more investors come into the market, and the pool progressively increases. It's not going to happen overnight. It's not going to happen overnight. And in any case, equity is just one in the matrix of financing opportunities, that financing windows that are used to bring any oil and gas project to the market. So the bottom line is the market can play a role. Now, looking at the debt capital markets, Nigerian banks have been able to develop a lot of competence in financing significant oil and gas transactions, mainly from the financing a number of field acquisitions that were devised by OICs. Okay, but we've not seen much pass through to the public debt markets, and Dr. Fatuna did give insight that they were able to get debt from the BOI, and we've been seeing that increasingly being helpful. But we've not seen the pass through to the public debt capital markets for a number of reasons. One, the currency of financing in the oil and gas sector mainly is in dollar. You can't raise dollar in the domestic capital markets, and the Naira cost has been quite high. That wouldn't have made the financial model make sense. But I believe there is a window of opportunity now with a low yield environment. We know that a lot of the banks are carrying a lot of oil and gas paper in their books. Perhaps now is a good time to find ways of taking some of those assets and bringing them by way of Naira bonds to the capital market, with the banks providing some level of backstop to improve the risk rating. That could work. So again, like my earlier message, we all have to think outside the box based on what we see. We have to look for local solutions, and I believe there is capacity to do that, and the market definitely can play a role for the right projects. So I'll stop now. Thank you.
Yeah, thank you very much, Mr. Eseka. And I'm going to quickly crave the indulgence of the panelists because of time management. Permit me to bring in Ms. Jadesimi now, and then once she's done, we will then come back to the panel and incorporate the audience Q&A. I hope that is okay. And Mr. Ogunfora, you'll be the first to speak once we come back into that section. I'd just like to get in Ms. Jadesimi to give her remarks. Ms. Jadesimi, are you still with us? Perhaps the admin just wants to check that she's still on with us. And if not, we'll just proceed. Okay, well, I guess she probably will come back on. And okay, so very, very briefly, Mr. Ogunfora, before we open it up to the audience Q&A, because time is fast spent. What should operators be doing right now if you are advising one of your clients to ensure that the funding cycle for business operations, whether it's asset acquisitions, diversification, what should they actually be doing in this climate to be in the best position to attract the funding that they need?
Okay, thank you. I think that there needs to be a change in the nature of the transactions. I mean, I think the typical transactions that are sort of like front-loaded in terms of the acquisition capex or requirements of financing needs to be, we need to be considering things like service contracts, profit sharing, overriding royalties, those sort of models, as well as the traditional farming models, wherein you sort of reduce the amount of money that you spend on the acquisition, and then sort of like, put your available money into the development of the assets. So that's definitely one that is nothing new in Nigeria, but it's just to say that we need to look at this in this particular environment. I would also say that there's a need to focus on the midstream and downstream elements of the business. So for example, this will help in matching actually the right investors with the risk return attributes of this segments of the value chain. So if you have a midstream component of it, look at inviting midstream partners to come and handle that element of it. A power element of your project, or a refinery or topping plant element of your project can actually be better matched up with some infrastructure or power companies that actually have the appetite to invest in sort of like the long-term capital that is required, and of course, commensurate with that, the cost of capital that is related to it. So when you're looking at it, look at maximizing your existing liquidity pockets. Sometimes we have assets in our businesses that we actually are overlooking. So if I do have, as an example, a pipeline within my business that is maybe owned, for example, by a couple of producers, look at using that to leverage the debt. I think Chuka actually discussed this in his comments. These pockets of assets that are available for you to leverage up will be quite important as we kind of walk ourselves through this new terrain. And again, when you look at it, the banks have the capacity, they have the knowledge, and you can easily see a situation where banks can actually come in and lead this sort of and structure this sort of products, and then invite the pension funds, the insurance companies, and retail investors that are looking for yield to be able to participate in it. So all of this will be structured and appropriately to be able to carve out the elements of the value chain that are actually quite for investors that have the appetite for it. So one of the other things that the industry players also have to look at is ensuring that they operationalize things at the right level. So for example, and a lot of them do it already, but you are encouraged to do it. So kind of like, look at listing some certain elements of it. Look at whether it's your FPSO, whether it's your EPFs, and things of that nature, such that your upfront capital is sort of a little bit reduced as you kind of go through. But I think ultimately, if industry players can focus on accessing debt, not just bank debt, but maybe debt that is actually available to a larger pool of investors, that's a starting point. And then you can then build on that to eventually offering products that are, for example, convertible debt or debt with equity kickers before you ultimately get into a full-blown equity capital base. Thank you.
Thank you very much, Mr. Ogunfora. So I'm going to come back to the operators on the panel. So I'm first of all going to come back to Seplat and then NDEP, Dr. Fatina, Mr. Onwuka. Mr. Onwuka, starting with you, there's a question here saying that the capital markets are obviously becoming much more socially conscious. How is Seplat integrating ESG principles and stewardship into its financial reporting and performance metrics? And this second question for Dr. Fatina is around the impact of Naira devaluation. Obviously, you run a refinery and your refinery has to source crude oil, which I presume you need to pay in dollars, but you're also refining products presumably into the local market, which may be sold in Naira or dollar. I don't know, perhaps you can paint that picture. How are you dealing with the FX devaluation challenge? So I'll go to you first, Mr. Onwuka.
Okay, I'll say that I mentioned that there's a drive towards cleaner energy, okay, which is really the environmental part of the ESG, okay. And what had happened, like I said, that globally, people are moving towards renewables. They're talking about solar, talking about wind, and all energy sources that are clean. However, for a Nigerian-focused company, we're still very far away in terms of energy sources that are decarbonized to make significant impacts in renewable in terms of solar and wind. What we've done is that we're moved to midstream, like I said earlier, to see how we can participate in supplying gas to the power company to displace diesel as a source of power, which has a very high emission and of course a significant carbon footprint. Now, we are also examining the renewable space in Nigeria. We are watching the growth of renewable space, particularly in the area of solar. And we are looking at solar now. Even when we look at solar and wind, we're also monitoring the improvements in battery technology that is enhancing the availability of renewables and trying to check in which segment we'll play. Currently, looking at the growth potential in the country in terms of trajectory, there is low absorptive capacity in terms of capital into that segment. So what we've done is that as a company, we are going to increase our report on ESG, from January, when we report our year end. We are going to launch a major ESG communication to the market. And then also in that process, be very specific in terms of our activities to reduce our carbon footprint, first in our own operations, and how we can respond to enhance renewables utilization in the country. Okay, I hope that answered that bit of the question.
Thank you very much, Mr. Onwuka. Dr. Fatina, the question on the devaluation of the Naira, and perhaps you may also want to comment to your thoughts on the PIB and its impact going forward.
Well, thank you very much. I think what is not very obvious to the Nigerian society is that we have to a large extent, a very responsive and very dynamic government and industry interrelating here in the oil industry. I would say dynamic in the context that as we evolve and as we become more successful, I just narrated the story of our refinery, and you have just brought about the impact of new problems that are going to emanate from sourcing crude oil, fortunately which we produce by ourselves, but still in accounting, the federal government expects that we would ordinarily sell all our crude for foreign exchange and therefore be liable to pay royalties and therefore all the statutory obligations in dollars. But I want to tell you that the responsiveness of government, and I take that from the way they have dealt with gas supply to domestic market. Quite a lot of people don't know that if you are a gas producer and you sell gas for domestic consumption, your royalties and accounting are allowed in Naira. So obviously, to a large extent, that problem has been substantially addressed for gas. As we now come into oil, crude oil feed into domestic refining by independent refiners, we've started constructive engagement with the regulators. We have put the problem right where it belongs, and I think there's mutual conversations going on. I strongly believe that at the appropriate time, the financial regulator will be brought into the picture. And just like the way that the gas royalties have been dealt with, I am very optimistic that the regulator and the practitioners like us would come to a very, very happy landing on how do you ensure that domestic refiners like us and new ones coming will have access to crude oil guaranteed either by themselves or through third-party purchases, maybe accounted for in Naira, and therefore the worries and concerns of foreign exchange statutory payments will eventually disappear. Now, the main issue that will not necessarily disappear tomorrow is we have funded the capital expenditure of these investments, borrowing dollars. And the banks obviously expect us to pay back in dollar denomination of the currencies. Again, we have to be very creative. There will be demands of us of refined products, not necessarily domestically, even if it is used within the realms of the domestic market. I can say today that as a company, some of our products are sold to our colleagues, operators, and by and large, I think they understand our plight, and they are very, very considerate and willing to allow such payments, even if it is on some kind of very considerate measures, still to be traded in dollars. But by and large, all I want to say here is that the regulator is quite responsive, and I think it is noteworthy also to remark that even in the investment front, to encourage the local refineries and independent refinery setup, I don't think many people were aware that the federal government graciously granted import duty waivers to each and every one of us who had embarked on this journey. So constructive engagement is what I strongly believe will help us to cross over this crunch of foreign exchange once we start large volume refined products input into the domestic economy.
Thank you very much, Dr. Fastener. And because we're constrained for time, I'm going to encourage all the panelists to please look in the Q&A box. There's some questions specifically for you, which you can answer. But I'm just going to go around once, rounding off on the discussion. And I'm going to start with you, Olivier. Looking at what has happened globally with most DFIs and multilateral financial institutions focusing on green recovery and sustainable energy, are we going to see a capital squeeze for hydrocarbons going forward? And, what side of that fence does IFC really sit? If you could perhaps comment on that in your closing statements. For the operators on the panel, I would like us to comment on the impact on the PIB for Seplat and NDEP. And then for the financial advisors and capital market gurus, perhaps you could talk about what big change you would like to see in terms of how both the commercial financial markets, such as banks, and the capital markets can work more collaboratively to support the domestic oil and gas industry. Thank you very much. I'll start with Olivier.
Thank you, Rolake. So the answer is yes, right? It is going to be more difficult. And there are places where you see the efficiency of the market working. The US is the best example, where debt have been rebalanced. So when you have taken on an RBL for, let's say, $1 billion at $60 oil price future, and now the oil price is at $40, internationally, there's a write-off, there's a bankruptcy, the asset goes to a new owner. In Africa in general, and Nigeria in particular, banks are not willing to take the write-offs. Moving the asset from an operator to a new operator who can then manage it isn't happening. So you are losing this efficiency, which means that there is a little bit of a drag going on in Africa at the moment, as far as, okay, how do we sanitize the oil and gas sector in general to make it financeable and bankable again, right? So that's one of the big aspects. The other side is indeed on the environmental side of things. Again, markets are very efficient. They see that the future from their point of view is renewable because it looks good. I mean, everybody talks about, oh, Exxon is valued a third of what it was. And whilst a renewable company is valued 3 times what it was, it's even worse if you are Toyota, which is valued now just about its valuation is now roughly half of what Tesla is. You have there's a real shift going on today, but it means that also there's an opportunity that we have heard just earlier about the investments that Seplat, that ND West are making into the country. And we can only encourage that, and this is where our investments will go. You have a population which is nearing 200 million people, which is going to go beyond that. And yet the manufacturing sector in Nigeria is worth half of what its contribution to GDP is half of what it was 20 years ago. We need to create these manufacturing jobs, and to have these manufacturing jobs, you need access to cheap and clean energy. And this is where there is an opportunity for financiers, where when we do an investment into gas, and which leads into domestic job, this has a huge ESG impact. This is probably the highest you can go because it hits both CO2, cleaning up the system, and creating local jobs and reducing poverty. So this is really for us, the bright, out of all this darkness, there is an opportunity to really, hit the reset button and go full speed ahead on going for these local jobs, local job creation, through investment into the domestic sector.
Thank you very much, Olivier, for those passing words. I'll come to Mr. Onwuka and Dr. Fasuna. Mr. Onwuka, are you still there? Okay, there you go.
Yes, I'm here.
Yes.
Okay. We are currently examining the version of the PIB that have just gone to National Assembly. As you know, there are various versions over the years that we'll be struggling with this act. We are aware, like we talked about earlier, because most of our assets are onshore. There are implications in terms of royalty, in terms of taxation, also in terms of both taxation of liquids and taxation of gas as well, and incentives to enable us make further investment in gas. This we are studying, and we believe ultimately, the way we are positioned in terms of today, we're probably doing gas about 35% of our production is gas, and we're also making heavy investments in processing of gas. We are currently undertaking the biggest gas processing project in the country today, which is the annual gas processing transaction. That's about $1 billion capex, and which is ongoing. And we'll have first gas by the end of first quarter, by last quarter 2022. And we're currently expanding our Oben gas plant and also the Sapele gas plant we are doing currently. And in all these investments in gas, we have structured the production to the processing structure to the extent that we deliver all to LPG and CNG as well. So we believe that ultimately this will pay off in terms of how the PIB will affect our operations and will take benefit, the PIB in terms of for our continuous investment and continuous attraction of capital, to make these investments in the country.
Thank you very much, Mr. Onwuka. Dr. Fasuna.
Well, thank you very much. In terms of the PIB, I think the focus here for us is our optimism. We have no choice. We are very optimistic about the direction in which the PIB would go. As a matter of fact, I think it's our optimism that has kept us very much in focus with all these expectations. Now, but let me say a very, very significant part of the PIB, which a lot of people may underlook. This is the impact of the host community aspect of the bill, because that has been elevated into some very, very substantial aspect for implementation by operating companies. And if I draw from the experiences that we have garnered over the years, the fact that we have managed to remain in production every day of the last 15 years stems from the way we have managed our host communities. And I think the host community aspect of the PIB is, something that ought to be commended and recognized simply because of what impact it will bring even to the operations and operability of the entire bill itself. As a company, we expect that all the protocols of the host community aspect of the PIB, stringent as it is, has been such that it has defined the way to deal with the very common problems of operators and how to manage their relationship with the host community. So this aspect of the PIB, beyond funding, the taxation, and how other aspects of the PIB will come into force, stands out for us. Just like Mr. Onwuka has said, we at Niger Delta have spent substantial amount of time combing through the current version of the PIB. We see scope for amendments here and there that makes it easier to run with. But by and large, I think it's opened up very substantial new vistas for what I call Nigerian independent companies. And I think our expectation is that the PIB, the bill, even though it's taking so much time to come, will augur a very, very new future for the Nigerian energy industry.
Thank you very much. So if I could just ask for a maximum of 1 minute each, Mr. Ogunfowora and Mr. Eseka, to please give their closing remarks.
Okay, so I'll go first. It will be a very long 1 minute. I think issues relating to how the capital market and the financial market, the banks can collaborate. I did touch on that a bit, and Olumide touched on that. Also, I would not repeat myself. Maybe I did raise some issues relating to how globally challenges with RBLs are managed, and wondering why we don't do similar, is the difficulty of doing similar things in Nigeria. And I think that can be tied to the structure of the industry. Anything you do in oil and gas industry, you do in partnership with government. So you have a right to your own share of barrels. You don't have a right to the whole field. So it restricts what you can do in restructurings, and you require consents, your JV partner approval. So it makes it a bit more difficult. That's why the banks have typically gone through the restructuring route based on the new economics that the prevailing oil price matrix puts puts in place. And that's the area we believe that probably we can find ways to pass through some of these obligations and cash flow and create instruments that the market can trade independently with the banks providing some level of backstop. I think that conversation can continue. I would like to focus my closing comments on what more we can do to ensure that a lot more companies come into markets. And I'll break it down into three. Advocacy. We have to continue this advocacy route, and the NSC and this SEC has been doing a lot, and it's advocacy that brought a lot of companies to the market. Second thing we need to do is to ensure that our markets are more competitive as a source of capital against other capital markets, and competitive from the point of other sources of financing. How long does it take to access the market? Time to market. How long does it take to access funding from other markets? Those issues are still important. And what is the cost of attracting a listing in Nigeria? What are the listing costs? So we've made a lot of progress. We're in a much better position now, but we need to make our capital markets more competitive against other capital markets and against other sources of finance. We also have to focus on the experience of listed entities. We've seen companies seeking to delist. Everything boils down to the experience. We have to make the experience more rewarding for listed entities. And this is another area where the NSC has been doing a lot of work. And regulation also is also important. You have to give corporates the opportunity to be able to express themselves. There are certain situations that being a publicly listed company actually restricts your ability to change your structure, because by nature of public markets, they protect minority interests, and that is good. But there are companies in certain stage of their life cycle that need to restructure, and that's why many times they delay so that they can restructure and come back. Thankfully, with the update of the CAMA, this kind of corporate restructuring are becoming more easy. But as new laws are coming up, new concerns are also coming about, and also so we continuously advocate for the right appropriate policy. Comments on the PIB. Yeah, I think what we're hoping for from the PIB is to bring in
Mr. Seka, sorry. For the sake of time, okay, the comments on the PIB was actually for the operators, so that we can give Mr. Okafora and some time. But very quickly, sir, please.
The point I just wanted to make that there's a lot of commentary as to the future of the oil and gas sector. I think we in Nigeria should be focusing on monetizing the oil and gas value chain. That will bring a lot of diversity into the market. Some other points, but I think we'll leave them for some other time. Thank you.
Thank you very much, Mr. Seka. Mr. Ogunfowora, over to you, finally.
Thank you. I think I'll just re-echo the thesis that I was talking about earlier in terms of taking baby steps, which are still gigantic steps for the Nigerian capital market. Looking at the banks, the insurance companies, pension funds, crude oil off-takers, and private equity funds to be able to, at least particularly with respect to their credit businesses, to be able to come together with the capital market operators to balance the supply and the demand of capital. For me, and I think as has been highlighted by several other participants in this session, you really need to go back and see what you can build up on the debt side. It's the easiest way for us to get things going, to build that trust and leverage the capacity that has already been there. The Nigerian banks are very well versed with respect to reserve-based lending. Take this product, take the leadership, take about 20-30%, structure these deals. Then you'll be the MLAs, you'll be the ones running the stuff and marketing it. And the fact that you're putting in maybe about 20-30%, which you already do today, it would encourage other folks to come into this stuff, because they know that this transaction has been de-risked and structured by people that are actually quite active in the market. And then as we go on further, we can then add in sort of more equity type of investment. But I do believe that the future, the current situation is challenging. While it's challenging, the future is actually still quite bright for the sector. Thank you.
Thank you very much, Mr. Ogunfowora, Mr. Chuka Seka, Dr. Lai Fasino, Mr. Emeka Onwuka, and Mr. Olivier Musa for lending your very, very insightful perspectives to this discussion. We could go on forever, but we don't have the luxury of time. And I would encourage you, if you're staying on, to please look in the Q&A chat box. There are a lot of specific questions. I see Mrs. Joezigo is already directly answering questions. So please take time, if you do have some time to spare, to answer specific questions that were put out for you. Thank you for staying tuned, ladies and gentlemen. We're now going to move on swiftly And I would kindly ask the organizers that we perhaps move the second Zoom poll till after the Downstream panel discussion so that we can have the next panel have their time on today's webinar. So I'd like to invite our moderator for the next session, Mr. Pedro Omotwehe, who is a partner and the energy industry lead for West Africa at PwC, to introduce the next panel and the panelists. Thank you.
Thank you, Rodlake. I think we've been having a great time since morning, from the opening remarks by the minister, from our friends from NNPC, to all of the very insightful discussion we'll be having today. So thank you for that, and I'm grateful that we still have a lot of panelists. Panelists are already set, and the participants are all on, over 300 and close to 400 participants from all over the world. So in this panel, we're going to be looking at the downstream sector, the challenges we have in the sector. Some of them have been alluded to earlier on, the deregulation of the sector, what prospects we have in the sector, what are the key challenges, what are the funding challenges with respect to the sector. So I've got 6 panelists this afternoon. Mr. Olumide Adeosu, please, if you can just, let's see you on video, who is the MD, CEO of Adova. Mr. Mahmoud Tuku is the CEO of China, please. Let's see you on video, please, Mahmoud Tuku. Mr. Timothy Onenewu is the Group CFO of Azela Group. Timothy, please, you can unmute and let's see you on video. Mr. Eric Edehe. Eric is the co-founder of Berod Capital. Mr. Eric, please, if you can. Thank you so much, Mr. Eric. Mr. Abdulkadir Abbas, Deputy Director, SEC. Mr. Abbas, please, if you can just show your video. And then Mr. Funsho Akere, CEO, Stanbic IBTC Capital. Fantastic. So this is a powerful team of very knowledgeable people in the industry and financiers in the room today. We're going to start off with just copying what Rolake did with her team, with a group, a few minutes for each of the panelists to tell us the impact of the pandemic on your business or your setup of the economy. So if I can start with Mr. Olumide Adeosu, what has been the impact, please? Because of time, I'm going to be trying mindful of time, so I try to encourage you to do this in 2 minutes each. What has been the impact of COVID-19 on your business? Olumide, please.
Thank you very much, Pedro, and thank you to all the panelists who have contributed before now. For us, it has been a most interesting year in the Chinese sense of the word. People talk of the twin shock, the US-Russia oil impasse, and the COVID-19 pandemic. For us, on the 19th of March, we also had a mini stroke. Mini stroke in the format that the triple PRA reduced the price, or the pump price, of petrol by 20 naira. What that did was it exposed us to a lot of pressure, a lot of price pressure, and we actually took a hit as well, not quite knowing where the pandemic was going to. So we had the shutdown. In anticipation of the shutdown, we had put in some business continuity. That meant that we really focused on a 6-point strategy, really looking to protect our enemies, stress testing our P&L, defending against the revenue decline, trying to stabilize our business to the new normal as it was then, paying close attention to cash is king, and lastly, making sure that we were not just looking at the threat that was presented by the pandemic, by the lockdown, but also seeking the opportunities that were available for us as a business. And we modeled it around 3 scenarios. One being that the lockdown was going to be short and localized. Mid-case being that it would be isolated patches, and the worst case scenario being an extended lockdown. I think as a nation and as an industry, we ended up in the middle, which was that it lasted for an extended period of time. But the impact to our business was absolute. The entire aviation fuel business was decimated as a consequence. No airplanes took off, which means that we barely sold a drop of fuel. As you know, we sell automotive fuels, we sell transport fuels, we sell lubricants. So all of that really shut down for us. Separately, the diesel market also fell apart because the major demand users no longer required diesel for their generators because they are shut down. And consequently, the power sector started focusing on making sure that there was power available to residential users. So we really saw the bottom fall out of our AGO business as well. Thankfully, we had anticipated something like a 70% drop in total sales. So we were able to pull through. Now, on the upside, I think Mrs. Essie had spoke of this Chinese proverb that JFK had quoted. On the upside, there was some opportunity in there. The opportunity came for us in the form of the very depressed price of PMS, which meant that over that period, we were able to bring in 2 cargoes as a company. And those 2 cargoes really were the difference between having a total loss in revenue and actually being able to still see some upside in spite of the lockdown. Where we are now is that we are really trying to make sure that our business is future-proofed. And what that means is that we are focusing, we had planned to do this before, but COVID means it's an accelerated play. We're now in a position where we're focusing really on building out our clean energy business, mostly LPG and CNG, and we're grateful to the government for the position it has taken, the very strong stance it has taken in that space. We are looking at renewables, very much so. We're looking at solar as a very, very likely alternative to diesel, and a lot of our stations are now running 100% on solar as a pilot. We're also looking at really trying to build out our non-fuels revenue. We have a lot of real estate, and we think there's a lot more we can be doing with that. So there's opportunity in there for us. And really, I think our success over the next 1 to 5 years is really dependent on how well we exploit and leverage those niche areas, technology included, to make sure that we remain an efficient company. We are operating always under the flagship or banner of safety, and that we are also focused on making sure that we squeeze margin, we extract value at every point in the value chain. So I'll stop there for a moment and say that overall, the net effect is not as bad as we had anticipated. It helped that we had braced ourselves for it, and we think there are many opportunities to be leveraged, depending on a few things, which I'm sure we'll talk about, the PIB, infrastructure, et cetera, et cetera. But I'll leave that for openness, Pedro. Thank you.
Yes, thanks so much, Olumide. We're obviously going to talk about all of the issues today. So let me go to Alhaji Tuko. People like to call you Alhaji. I think the talk is much better. So talk to us, how has this pandemic affected your industry particularly?
Thank you, Pedro. Good morning, also good afternoon, and thank you to the NSC as well for having me on the panel. I think the pandemic, first of all, if I speak for the industry and specifically for the company that I just recently left, Eternal PLC, first of all, afforded the company to actually check its business continuity protocols. You have them in place, you put plans, and all of a sudden they're stress tested. We were able to move the company to remote working, I think 2 weeks before Lagos State actually rolled out the lockdown. So once you have an ERP in place, you have everything, systems are online, and you have people in remote locations are able to work. We didn't shut down operations. So depots were working, the blending plants were working, customers were met. And interestingly, in that crisis, there were opportunities. So where our competitors were not able to deliver products because we were open, we were able to gain market share. Where some stations are shut down because we were operating 24 hours a day, we're able to sell to our customers. So I think that actually was a good opportunity. There were margins to be made from trading. The risks that came with the pandemic, obviously, yes, the FX risk manifested because all of a sudden there was no FX. So you could trade in cargoes at an assumed price of an FX and it wasn't available. So that was a major risk. There was margin on paper before you could close out. I think I'll just stop there in the interest of time, because I know we're way behind schedule.
Absolutely. Thanks so much. Eric, we're going to turn over to you. How did the pandemic affect your industry and did you respond?
Sure, thank you. So I can only speak from an investment perspective as a private equity firm. Our existing portfolio companies, of course, we viewed the pandemic as both good and bad. So for us, we've had to go back and look at how they cut costs and be more efficient across board companies we invested in. But of course, it's been slow for business across just not businesses we're invested in, but across the country. But notwithstanding, we're very bullish. I think for us, we're more excited now and very eager to deploy a lot more capital into Nigeria because we feel those that actually survive the pandemic and those that are more efficient would actually end up being much bigger and better players going into the future.
Thank you so very much. Mr. Baz, how did it affect the regulators?
Thank you very much, Pedro. And let me start by thanking the NSC for organizing this webinar. I think it is really commendable. For us from the SEC, I think the impact of the pandemic is so challenging. Starting with the lockdown, when we now have to direct or advise all the market operators, including the regulators, to put a kind of business continuity plan in place. And I think that really helps us. I think for the first time, I see us as regulators trying to align with the current realities in terms of working remotely and trying to see how we can be able to really turn off transaction in good time. I think one interesting thing that I would say, one milestone transaction that we were able to really turn around in good time, one major transaction that we never even had it in the market before. An issuer raising almost 100 billion during the pandemic, and we're able to really see it that we turn it around in good time. I think that is really an interesting, stand for us. Generally about the market, I think all of us have now faced the reality, and business continuity plan has been put in place. We additionally try to see how we can engage other regulators. For instance, engagement with the CSC at the beginning of the pandemic, trying to align certain processes as per the provision of PAMA to allow transaction to fly. I think those are great issues that I think we put in place to really see that the impact is actually minimized to allow transaction to fly and to allow the market to ride on that. I think I can stop there and then we can maybe have further conversation along the line.
Thank you so very much. So clearly we have seen the benefits, the consequences and side effects of COVID, and also some benefits. One of the benefits that we can have this webinar, some of us are in our houses, some of us are in the offices, and we don't have to travel. And that, yes, we are still having a very exciting discussion. Okay, Mr. Timothy, how has it affected your business?
Well, thank you, Pedro, and thanks to NSC for organizing this, I must say. Our experience is not much different from what the other panelists have said. Fortunately, we are in the gas distribution and gas development, pipeline infrastructure development business. In our portfolio, fortunately, we have a very well diversified customer base, and that came in very handy during this period. You can characterize the customer base or put them into different buckets, the essentials or deemed essential part and the non-essential part. Most of our customers falls into that essentials category. And because of that, we're able to withstand the impact of this COVID, of the lockdown. Customers in the food and beverages and the power sector, they had to operate regardless of the impact. So we supplied gas to them, and that cushioned the potential negative impact of this COVID. So we didn't see much. There were some dips, in our gas distribution, but the performance was very close to where we budgeted it. Now, on the other side, we did some scenario building, stress testing to ensure that we had enough liquidity to last us through the period. So we assumed different scenarios and ran them out, put some trigger points that would allow us to effect certain protocols that we have already mapped out. So if pandemic were to go to a certain level, we had to trigger certain protocols to ensure that we stay online. The second thing, the other thing I should mention, it's the support we actually received from the regulatory agency. I see Mr. Baz there. They were quite helpful. In the midst of this pandemic, we raised our first capital market issue. It's 11.5 billion naira in local bond market. So it shows the resiliency of the financial sector as well as the effectiveness of the regulator. So we're able to raise the liquidity that we need, and as well use that for even capital expansion, even during this period. In every crisis, there is an opportunity. So we look for that and pursue it. So I'll leave it here for now.
Thanks, Mr. Timothy. Just before I take on Mr. Funsho to also give us a perspective, I just want my participants to know that they can ask their questions. There's a Q&A chat. You can ask questions. And then once we get to the question session, we will take on those questions. So, Mr. Funsho, how did this impact your business?
Yeah, good morning, all. I think Mrs. Eshiet summed up the impact of the pandemic with her quote on the two Chinese brush strokes for the word crisis, one for danger and the other for opportunity. And this has certainly been a recurring theme in our strategic dialogue with clients over the past 6 months. I'll touch on 3 points first very quickly. I think the first thing we've seen is resilience. Downstream players have demonstrated remarkable resilience despite having to deal with the twin shocks of drop in oil prices and the COVID-19 pandemic. Olumide and Mahmoud touched on how this has impacted the downstream sector, so I won't rehash it. Several companies will come out of this leaner, more efficient, and in a better shape to raise growth capital. I mean, Olumide and Mahmoud both certainly look leaner and more upbeat. The second is opportunity, and there are several opportunities. In our opinion, we think that there are several opportunities that will emerge from the deregulation of the downstream sector, as well as industry themes such as energy transition and consolidation across industry verticals. We are spending a lot of time with our clients to explore strategic M&A as a means of capturing opportunities across the downstream value chain. I think my final point is on the availability of local currency funding. There has never been a better time to source local currency funding from the bank or capital markets to fund expansion or even refinance USD debt and avoid that currency mismatch. Interest rates are low and there is significant market liquidity. Pension funds had 11 trillion naira under management as at end of June. Also, the central bank, as part of its support for the real sector, has introduced intervention funds, which have extremely attractive terms. The Nigerian Stock Exchange and other regulators have made it easier for companies to issue bonds and CPs to fund long-term expansion projects or just working capital. In 2020 alone, Stanbic IBTC Capital has raised about 600 billion from the debt capital markets for our clients. So I'll stop there and hand back over to you.
Okay, thanks so much, Funsho. I think just listening to the opening remarks, there are questions already popping out, and things that we're going to discuss. I hope we have enough time. We've been allocated 30 minutes, and I'm just worried how are we going to deal with all of these things in 30 minutes. So Olumide, I'm going to come back to you because there are two issues right now in the front burner for Nigerians. One is the PIB, and the second is the deregulation. Okay, and we're going to spend some time dealing with that issue today. So Olumide, you know, under the new PIB Act or the proposed act, there's going to be the scrapping of the current NNPC and the formation of a new national oil company, if I may use that word. And you know that the NNPC is playing quite a significant role in the downstream sector at the moment. So what, in your view, will the downstream sector be, a deregulated downstream sector without this NNPC? So you need to unmute Olumide. Unmute.
Sorry about that. So I think the two themes are sort of connected. The PIB is really about cleaning up the regulatory environmental framework for our sector, and the regulation is really around loosening or removing government's participation in what should be a free market concern. For me, at least for our business, for our Dover, the cohesion around regulatory entities. We're currently looking at the situation where we answer to the triple PRA, the DPR. We also have a few state regulations that all sort of collude to increase, and that's kind of some of the net effect, to increase the overheads associated with running our business. I think with the passing of the PIB, particularly the formation of a singular regulatory body that covers the midstream and the downstream, means that there are opportunities to actually take some costs out from our point of view. It will behoove me to speak for the government, but I think from the government's point of view, it also creates an opportunity to really streamline the cost structure around the cost of governing the industry. From an investor's point of view, we're all in the, we're going to talk about M&As, but we all kind of need not just local players taking an interest in this market, which is probably the largest short as far as refined products go, close to anywhere on the planet, apart from Asia. It also means that there's an opportunity there to give investors the confidence, and that will only come when the PIB becomes law. The signal by the government has been powerful, it's been impactful. A lot of international players who were not talking to us before are now taking a keen interest in the market. So it brings investors into play, but it also creates confidence for investment for us market players. So where you have a budget to deliver on some projects, I've just told you about some of the things we're trying to do. If you're not sure where your margins are going to come from, or where you can't bank or model what your future earnings may be, it's going to be very difficult to plan and to budget accurately. So the passing of these two initiatives are very welcome, and they can only bode well for the government. I think the question, for the industry, and I think the question really should be how quickly can we get this done, such that we can really start to professionalize and liberalize the market in such a way that it competes aggressively with the best on the continent for certain, and certainly across the world as well.
Okay. Thanks so much, Olumide. I'm sure we're going to come back to that issue later on. Mr. Mahmoud, I'm going to swim in dangerous waters, and I know you're going to swim with me here. So on the one hand, we're talking about deregulation, but there's also a bit of regulation of the pricing in terms of the equalization of prices. So what's your view? How do you deal with this twin issue of deregulate the market, but let there be an equalization of prices?
Thank you, Pedro. I think you've answered the question. Price equalization and deregulation cannot coexist. So PEF, as it is currently constituted, in my opinion, has no future in a regulated market. We're waiting to see exactly, obviously the PIB is a draft, so we don't know what the final outcome will be. But yes, if you scrap PEF, you're going to have different prices across the country in a deregulated market. So then there will be opportunities to look at additional infrastructural development to try and get products to markets at a cheaper cost. But as PEF is currently constituted, it cannot coexist it cannot exist in the deregulated market. So we wait and see.
Okay, we wait and see. Thank you very much. Okay, Mr. Timothy. So when I listened to the representatives of the GMD earlier on, and even the minister, one of the things that was common with the speech was the issue of gas. Okay, and you are in the gas sector of this industry. So what are the players in the sector doing, or what should they do to facilitate the growth of the use of gas?
Well, I'll take a broader definition of players. It's not just those of us practitioners, if you will. But also the regulator has a role to play. The policymakers have a role to play. What we have been doing, I think a good step is to establish some of these associations that have been established, NGA being one of them, to ensure that good regulation, regulatory framework it's put in place. And also for it to be consistent, because without consistency, it's difficult to plan investments. I think that's one of them. There also needs to be an awareness. In fact, those of us in the sector also have engaged in some level of awareness campaign to educate not only the public but also the industry about the benefits of gas. It has environmental benefits associated with it, but also have to do something to expand, build out the infrastructure aspect of it, because that's the only way you can get gas to the ultimate consumer. And that includes not only pipeline infrastructure, but also virtual pipeline. Some of these customers are not in the on the pipeline grid, so you have to reach them. Yeah? You do that through virtual pipeline. So the government also has a role. You know, virtual pipeline is really a logistics business. The roads are not the best that it could be. If we have a good road infrastructure, that will lower the cost of these products, and that will pass on to the consumers. So those are some of the points I will put on the table.
Okay. Thanks so much, Timothy. Let me now go to the banker in the room, Funsho, and then maybe I'll come to the investor. And you know, you talked earlier about what CBN is doing, reducing interest rates and special funds that are valuable. What can the players in this industry do to attract funds that are valuable globally? What can we do to attract funds?
I'll summarize that maybe in 3 points, maybe 4. I think the first is governance. And you know, governance is extremely key to attracting capital. And when I talk about governance, it's talk about your appointment of INEDs on your board, diversity on boards. I mean, I've been for investor roadshows where, you know, our clients have been asked, you know, the people who are here to present the opportunity, there'll be no women in the room. So people are asking, you know, real fundamental questions. You know, what is the composition of your board? Is it diverse? And whereas a firm are, you know, working with our clients to ensure that, you know, they meet their diversity targets. The second, you know, I'll also talk about, you know, their financial reporting and disclosure requirements. So governance is very key. And when you look at, you know, the stock exchange and, you know, trying to get on, you know, the highest platform on the stock exchange, you know, companies that are able to access that premium listing, you know, will be companies that are well positioned to attract, you know, significant amounts of growth capital. So that should be aspirational if you're a listed company. The second is carefully crafting your equity story. And you know, I talked about, you know, significant pools of liquidity out there. But you see, how do you attract this liquidity? It's all down to your equity story. How are you able to communicate to investors where you expect growth to come from and how you will capture those growth opportunities? We've talked about opportunities across the industry verticals. You know, how do you expect to play in those industry verticals? If you have retail stations, how can you turn those retail stations into a platform business? All this need to be, you know, carefully articulated and translated to your numbers. And the last is probably, you know, having the right capital structure. If you're over leveraged, it's important that you deleverage. It's important that you raise that buffer. I mean, cash is king now. So it's important that you start to look at the structure of your balance sheet and you know, raise equity. I always say that it's better to own, you know, 30% of you know, of a massive, you know, growth opportunity than 100% of a dying business. So you know, it's important that people, you know, get their balance sheets in a position where they can quickly raise growth capital where there are opportunities. You know, firms like Verod, which Eric represents, you know, are constantly looking for, you know, good companies, you know, with significant growth opportunities to back. So, you know, strategic M&A, businesses need to be thinking about raising equity capital, and all these things should really, you know, position downstream players to attract, you know, pools of capital.
Okay. Thanks, Funsho. Now that you dragged Eric in, Eric, I'm going to be asking you the next questions. So the market is deregulated, or we're continuing the deregulation story. What areas of opportunities are you interested in as an investor? I mean, I'm sure you're already assessing the market. So what will interest you as an investor in the downstream deregulated market?
Yeah, I mean, first I must say it was very, very difficult to actually look at companies or invest in a market where there's regulation in that sense, because there, of course, non-market forces determine prices, and there's no true competition in that sense. But now that the market is opening up, we're very interested in looking at things that really, first of all, encourage import substitution, so modular refineries, storage facilities, and somewhat LPG plants. So things that really encourage local manufacturing or local capacity building in that sense. But more importantly, like Funsho said, not just looking at the sector per se, but looking at individual companies that can actually prove that they have capacity and they can be efficient, they can cut costs, and they can compete better than anybody else, but also have that strong governance and ESG, as one of the panelists spoke about earlier on. So those things play a big factor in companies we look for and things we look out for in trying to make investments.
Thanks so much. I actually was hoping that you give us some tips of the companies you go and buy, but I see you're keeping the secret to yourself. Okay, so Abbas, what is the regulators doing, either yourself, SEC, or even the NSC, to encourage more of the oil and gas companies, the downstream companies, to participate in the markets? What is your regulators? What are they doing at the moment?
Thank you, Pedro. I think we are doing quite a lot, starting with the fact that our focus is to be able to really put a lot of regulatory framework in place to encourage these companies to come to the market. And I think if I can start by saying that from our own perspective at the SEC, if you follow the trend, you can see the migration that we did in terms of bringing clarity, in terms of coming up with the rules of equity issuance, separating it from the debt issuance processes, and try to even streamline this issuance process to address the issue around this time to market issue. And I would give a perspective, even when we started, if I could remember, some of the transactions that we handled, like the Sectoral transaction that we handled, it was a global offer, dually listed in 2 exchanges. And I can see a kind of harmonization that we did, trying to harmonize the disclosure requirement with what we have in our own jurisdiction, with what the UK authorities were requiring. So we're able to really harmonize, and that is one area that we take as a takeaway issue. We try to fine-tune our own rules to allow those kind of transactions to take place. So for instance, if you have a global offer, for instance, by an offshore issuer, you can be able to do it in our own market in a seamless way. That is one thing. That is on Sectoral. And I remember that transaction is really, it gives us a good insight into what we need to do to amend some of our requirements. We were able to achieve that T+3, trading cycle that has been planned in that kind of transaction, simply because there is that kind of synergy between us as regulators from this side and the UK listing authorities from the other side. That is one. Now, in terms of even allowing or encouraging more downstream or upstream sectors to come to the market, we try to come up with a kind of regime distinct from a retail kind of processing. When you have an offer that is meant for institutional investors, for instance, we have a framework that you can be able to review that kind of application within a good time frame, so that you can be able to allow that issuer to access the market in good time. Other issues that we did in terms of trying to bring or harmonize issuance process, for instance, we still have our own process with that of the NSC and even the FMDQ, to try to say that, look, let's see how we can have like one-stop shop when you come to like filing these kind of applications. All these are geared towards opening up that space or trying to encourage this kind of transaction. But more specifically, when you talk about oil and gas, we realize there are certain disclosure requirements or regime that are embedded in those kind of transactions. For instance, when we're handling Sectoral, we had cause to now look at this competent person's report, which is somebody that is actually versatile or knowledgeable about that industry, that can be able to give an independent report. And that report has to be embedded in the offering document. So we try to now provide that kind of requirement in our own rules to just try to open up that space. Then again, when you now look at other players in the downstream, apart from Axela, I think we try to now see how we can encourage by reaching out to other critical operators in that space to try to advise or encourage them to see the benefit of coming and raising a long-term capital. One thing that came to play, even if most of these operators in these sectors go to the bank to borrow, capital market is an avenue to refinance those kind of borrowing. So you come, raise fund for refinancing, essentially this short-term fund that you have already taken from the banks. I think there are great opportunities in both equity space and debt space that they can be able to leverage. And from our own side, we try to have a framework or a kind of strategy of engagement. You don't need to wait until when you are ready to come to the market. You can engage us. You can come and even do a kind of share filing. You just put it on the shelf. Anytime when you want to come and do the issuance, you can quickly come and then write on that share program, and then you can write. You can raise money from the market. I think these are some of the building blocks that we try to put in place. And lastly, the issue about engagement, because it's not just one side affair. We know regulators on one side, market operators on the other side, and issuers on the other side. Let's see how we can have this collaborative effort. You know, it's a market that we need to build, and there is that need for that synergy much more than ever before. I think this COVID pandemic has given us good insight, good opportunity to see those opportunities that we need to harness, and we need to now carry everybody, along. Try to see how we can do serious engagement, and that is why I say really this kind of webinar is something that we need to find a way to have an ongoing discussion, even after the session. I think let me stop here for now.
Thank you so very much. So clearly, the issue of corporate governance has come up several times now. Corporate governance, planning, preparing for the future. That's quite clear. Okay, Mahmoud, I'm going to come back to you because there's no way you're going to talk about the downstream sector, whether the mainstream or the downstream, without mentioning the word Dangote refinery. Okay, with 600 barrels planned for the refinery, and I've heard about modular refineries being mentioned earlier on. We'll probably come to that a little bit. But with Dangote 600 barrels a day refinery, I think that's going to be a major shift in the industry. So what, in your views, are the opportunities or the threats resulting from the Dangote refinery in the Lekki Free Zone? How will it affect the other players in the industry? Mahmoud, please.
Thank you, Pedro. That is the big elephant in the room that every downstream player is trying to grapple with. Naturally, the first thing that's going to change is the supply dynamics. Nigeria, we've been importing fuel for longer than I can remember because our refineries simply don't refine locally, and therefore we need to import to meet local demands. So that's going to go away. And that might take some pressure off dollars, so that we might see an improvement in the Naira-US dollar exchange rate. And I'm an advocate. For example, we produce oil upstream, we sell it in dollars, but when you see, when you talk about federal allocations and sharing amongst various areas of government, it's in Naira. So we take the dollars, convert back into Naira for local spending. So when we sell crude oil in Naira, is the dollarization of the economy, is that part of what is heating up the exchange rate? So if we're not importing, if Dangote is buying fuel, crude oil in Naira, what impact will that have on the economy and on the exchange? In terms of the impact of the refinery in the downstream market, it's going to be massive. So yes, we will not import anymore. Products are available locally. For marketers who have access to that refinery, they can take positions. We don't know what Dangote's strategy is. Will he remain purely a refiner, or will they become an integrated player? Remember, they have upstream assets, they have midstream assets. Now with the refinery and trading, they easily have the platform to actually set up an international trading desk and rival the majors. So where the likes of Total and Shell and BPs and so on are successful in this market, Olumide had mentioned this is probably the largest short in the world outside of Asia. So a short means there's a demand for products to be supplied. Traders, international traders, are making good money from supplying the market. All of a sudden, if that market is locally supplied, what's going to happen? And if the company controlling that market decides to also play internationally, then it is not just Nigeria, but the entire West African market is at play. So there's a threat to international traders. For local companies, if the Dangote refinery do not get involved in the end market, go to the entire value chain and actually trade barrels into the market, then those who are able to enter into long-term offtake contracts will be able to ensure that they can pick up products and then take positions, supplying whether it's Ghana or Lomé or Cameroon or wherever the markets are, because there's a very strong cross-West Africa trade. So that's one opportunity. I mean, those are the threats, and for Nigerian companies, there are opportunities there. There'll certainly be more opportunities in coastal traffic. So I see improvement in coastal shipping, both in terms of barges and in terms of tankers. So I think that market, the maritime market, will see an increase in operations and opportunities. Certainly, more tank farms are going to be built in the free zone area to take advantage of co-location near the refinery. There's a lot of agitation to move tank farms out of some congested areas in Lagos that are causing a havoc. So you might see a longer term movement to newer facilities to offer distribution. So I think that's going to be the impact immediately. Now, again, we will see more with a market that is deregulated, with products availability. We may get involved in seeing more players play an active part in hedging instruments. So longer term hedging, because hedging against exchange rates, hedging against price volatility. These instruments are not currently available in the market. There's too much exposure from the trading segment. So I think that will be the impact of the refinery. And it really depends on exactly where the owners of the refinery will stop. And that's where the opportunities will come from. Thank you.
Okay, thanks so much, Mahmoud. I kind of like the way you're giving the broad and deep answer to that. Olubide, I'm going to come back to you with the next question. So with the recent happenings in the industry, the COVID-19, the drop in oil price, and the regulation, do you see, of course, maybe based on your own current and previous experience, do you see a lot of M&As happening in the downstream, and there's full-blown M&A or some partner, whatever, some special arrangements? And what are your views about that?
Yeah, I absolutely. I'm not sure which of the speakers or which of the sessions it was mentioned, but I think consolidation is an absolute must. If you deregulate the market, you put in a framework for the PIB, then you're going to have, you will see a separation of the professional companies and the interlopers. What do I mean by that? I mean, so this is one of the sectors, and I think these guys are the unsung heroes. There are people who go out and individuals who make deep investments in this sector. You have guys, these are the true guys who are investing in Nigeria. They buy vessels, they buy tankers, they buy tank farms, individuals buy everything. They take on a lot of debt and they buy all these things. And then they also play by the rules, right? So us as a PLC, there's very little that we can get away with, right? As good corporate citizens that have a strong governance framework. So I think there is a prize actually at the end for these sort of guys. And the consolidation we will see, it's inevitable. It's been happening anyway, but it will happen, I think, probably at a more accelerated rate. Will be both intra-country and I think it'll be international as well. For the IOCs, yes, Shell, Equinor, BP are all moving towards a net zero life by 2050. But the reality of the matter is that the world will still be fossil fueled for the foreseeable. Yes, Tesla is also has a larger valuation than Toyota. But I think our world here will still be fossil fueled. And the attraction and the prize is in the size of this market, 19 to 20 billion liters of PMS a year, a declining 4 or 5 billion in AGO, et cetera, et cetera. So what we're going to see is a deeper interest in, I think, foreign companies trying to participate in what's left of the arbitrage in the fuels business. So I think, and you'll also see, I mean, in Nigeria, we're not fond, as you and I know, Pedro, of alliances and partnerships, which is why you have the moment members, and each one of them has, we all operate a fleet of God knows how many tankers. Well, the spend on all those tankers, if we put all that spend together, you could have built a physical pipeline, which is actually the most efficient way to transport fuels, right? But we don't do that. But I think with with the free market and the push for efficiency, it will have to happen. Players will start to really look at collaborating to make sure that efficiencies are really gained. And I think with the interest from international players, we'll also see more of that happening. I think we'll also see some unusual partnerships as well. So let's think beyond oil, right? I'm a firm believer in the energy transition. I think it's real. And I think that contrary to what one of the earlier speakers said, I think that even for us, we may and we will have to confront it and start that planning today. I think you'll start to see a merging of technology players and maybe downstream players. You'll see a merger of core retailers and downstream players. You'll see a merger of microfinance players and LPG participants, so that they reduce the barrier in adoption of LPG as a fuel. So I mean, I think we'll see private sector players, downstream players participate in really looking to build some infrastructure. I think Mahmoud gave a very good thesis on the impact of the Dangote refinery in country. I think there's a great opportunity there for the midstream as well. You know, virtual pipelines are just not going to cut it. You cannot have one of the largest refineries on the world, or top 10, top 6 actually, in the world, situated on the southeasternmost part of the country, expecting to somehow magically and virtually carry fuels to every nook and cranny of this great country of ours, as well as neighboring states as well, potentially. So you're going to see and these costs are huge. So for them to be de-risked, the market participants and the serious players will really have to look at engaging others such that the risk of making these deep investments are shared. That's how it's done everywhere else in the world. Throughout my time at BP, I never saw BP actually go into an infrastructure play on its own. Most of the refineries that BP owns, most of the refineries that are owned worldwide are owned by multiple players. So I think it really is a great opportunity. And where you have these unlikely partnerships happen, then you're very likely to also see a faster rate of leapfrogging for us. You know, I mean, a lot of technology has a lot to, has a large role to play in this. And then there are some not very obvious M&As, but I dare I say it, government as an enabler also has a role to play in this. So to the extent that the rail network, which is progressing nicely, I never thought I would see a standard gauge network extending beyond one state, but that's happening as well. So you then start to look at some of these things to say, well, can we incorporate that as well into the transportation of fuels? We thought it's been done before, but it always failed because the infrastructure was just not robust enough to withstand it. But as we look to simplify the industry and as we look to really modernize the industry, these are all considerations that will have to be made. And it cannot be made by individuals or by individual companies. They will have to be the result of partnerships between companies that all have different capabilities and different roles to play. So I think it's inevitable, and I'm really hoping that actually, again, just to add, just to keep hammering the point, that the sooner the market is liberalized, the faster people will be able to feel that they can actually start to think along these lines. So absolutely possible. Pedro.
Okay. Thanks so much, Olumide. That's quite an insightful answer. So I'm going to come to Funsho now. Just listen to Olumide and the opportunities that exist in the deregulated or liberalized downstream. Is the Nigerian capital market, Funsho, is the Nigerian capital market deep enough to invest in this? And if not, where is the funding going to come from?
Look, the short answer is yes. I've been operating in the capital markets for 21 years now, and I must say that market conditions are very supportive at the moment. I think I mentioned earlier that Stanbic IBTC's capital has raised about 600 billion from the debt capital markets this year alone for our clients. We worked with team at Accela to raise 10
billion naira in 7-year funding at, at attractive interest rates. Interest rates are low. I think I checked, the treasury bill rates are down to 2% now. There's significant market liquidity sitting with institutional investors. So, there's the opportunity to fund, businesses and these opportunities. However, it's important that industry players properly articulate how these opportunities will translate to both immediate and long-term growth in earnings, when engaging with investors. Olumide and Mahmood and team, they've touched on this a bit, and it's important that that's carefully captured in, the equity story that you tell to investors. There's also, we haven't talked about it, in this webinar, but there's an increasing pool of attractively priced capital available for funding sustainable projects, green bonds, ESG financing, which if you think about the downstream sector and gas, and we're talking about auto gas now, etc., industrial gas, there's just so much liquidity out there that can be tapped. There's also the equity capital markets that we haven't talked about. So we've talked about the debt capital markets, but industry players can raise equity capital from both local and international institutional investors, HNIs, as well as the public retail investors. We've had little activity in the past few years, but market conditions now are just extremely very supportive. If you're an institutional investor looking at where can you invest your funds, the money market or fixed income market isn't giving you yield. So you're going to want at some point to get increased returns, obviously taking increased risks. So I still keep going back to, again, the importance of just capturing this in a proper, growth story. We've raised, significant amounts of equity capital for companies, including, Mr. Abbas talked about the Seplat IPO, where we helped Seplat raise, $500 million. And obviously the last then becomes, private equity. There's debt capital markets, equity capital markets, but you can raise private capital from private equity. And you have the person right there to give us his own perspective, and I'm sure he would anyway. Yeah.
Thank you so very much. So Eric, again, just listen to Olumide and Funsho, I just naturally gravitate to you next. So I hear there's so much money out there, okay, and there's so much opportunity out there. So my question, what kind of companies will you not invest in? What will repel you from downstream companies or midstream companies that you see? I don't want to mention names, and we're not mentioning names, but there are some attributes you will see. Say, I will not put my money in here. Sorry that I'm putting you on the spot. But what kind of company will you not invest in?
Yes. So you're right. There's a lot of capital out there, but there's a lot of smart capital out there. So investing, I think the bar has been raised. I think Funsho touched up on a lot of other things in this earlier conversation. There are things now we look for as a private equity firm, and one of the biggest things is ESG. How good is your governance? How good is your environmental, social, and governance? The full definition of ESG. How many your board composition? Is it diverse? Do you have a diverse board? Do you follow all the right corporate governance issues that need to be followed? How do you deal with the environment? So those are things that we look for. Those are the soft issues that we look for in investing. But also it's just looking at just back to the basics of business. How efficient do you run business? How competitive are you compared to the other person? Are your costs 10 times more than your competitor or 3 times more than your competitor? Are you able to navigate some of the issues you have with government, with regulation, etc.? So those are things that we look for in investing, in making sure that at least you're setting the bar higher than your competitors.
Thank you so very much. Okay, so Timothy, there's this global push for reduction in emission and the net zero carbon emission or reduction in fossil fuel. How do you see this push affecting business in Nigeria, particularly in your industry? Has it aided your business or is it a setback?
Sure. I think the only constant, as they say in life, it's change. Clearly that's a new world order that is trending. And investors have keyed into that. You know, I think Eric just mentioned one of the soft, I guess, considerations they make on investments is your ESG for your company. You know, fortunately in Axela, we take that very seriously. You know, we've not only corporate governance, but also ESG. We make sure that we're up to date. So gas, fortunately, it's one of the clean fuels. So it's important that that's highlighted because there are different kinds of fuel that power an industry. You know, gas, fortunately, is within that band of what's characterized as clean fuel. But zero carbon emission requirements are real. It's actually been a shot in the arm for the gas distributors, for example, because it's one of the benefits that you can provide to an industry in the operations. If they switch to a clean fuel, they will be meeting that target. They will also be attracting investments into their industries. So it's a positive from our standpoint. Now, we recognize that we're in a developing environment, a developing country. So I think someone, either Mr. Adesho mentioned that, or Mr. Tucker actually, Alhaji Tucker, mentioned that, you know, these fuels have to live side by side for a very long time before full transitioning into a carbon-free environment. So there is room for growth in our environment for both parties. But clearly, the world is trending towards a carbon-free environment. We just have to make sure that we progressively increase our footprint in that segment, and not shut our development efforts simply because we want to be completely carbon neutral. But I think it's clearly a trend, and it's a clear requirement for some investors. Some investors cannot even invest in companies that don't have a path to being carbon neutral, zero carbon emissions. So it's real, and our industry is taking it very seriously, and I think it's very supportive of our growth strategy.
Okay, thanks so much, Mr. Timothy. Mr. Abbas, I'm just going to come back to you now, and then after that, I'm going to go back to all my participants to give me like closing shots before we look at the question and answer box. Mr. Abbas, in this season of COVID-19, and there are all kinds of palliatives that are being granted by government all over the world. What are the palliatives that your organization or any government organization is granting to the capital market? Are there palliatives for those who want to come to the capital market?
Thank you. I think if I can approach the question, one of the palliatives that I can mention is to try to see that, look, you allow operation or businesses or transactions to thrive. I think that is one of the greatest palliatives. How do you do it? What you need, what we put in place is to ensure that transaction doesn't suffer. Issuers can be able to really come, do the filing online, and be able to interact with the SEC online. That is one of the ways that I feel is a way to really encourage, transaction or the market to ride. Once you have that one, and then again, trying to even look at some of the ways to simplify issuances or transactions in general. We have certain regulation that we have, but in this time of COVID, you need to find a way to work around those kind of rules that seem to be an kind of impediment in view of the current realities. And I think we have demonstrated that. For instance, like certain kind of meetings, which you can be able to do it, online virtual meetings, for instance. I think these are some of the things that, as a regulator, you need to be responsible to look at the issues that will really be an impediment, with a view to really resolve that kind of issue. In terms of trying to even look at the filing, for instance, we know that there are some issuers that have challenges in terms of timely filing of their reports. In that case, certain concession or waivers were considered for those kind of filing or issuers that were not able to have genuine reason that they cannot be able to file certain returns as at when due. Of course, collaboration with other regulators is critical at this point in time to try to see that areas that seem to be an impediment or that seem to be a challenge are being addressed collectively as a market to allow a lot of transactions to take place. One other issue that I can mention, it was during this pandemic that, if we could call, NICOM announced recapitalization of insurance companies. And what we did is to try to see how we can collaborate with NICOM to see that certain extension were even granted, and then I think locally NICOM have even granted extension for this recapitalization. And we try to see how we can work collaboratively to support insurance companies that come during this pandemic in trying to even fine-tune or give them certain waivers in terms of complying with some of our rules to raise capital. I think those are some of the areas that I can say we have really worked on, and there are other issues that are still work in progress. The bottom line is that you should be able to see that things thrive seamlessly without having any challenge or hindrance in terms of allowing the market to really ride on. And I think really that is the way to go.
Thank you so very much. Thanks so very much, Mr. Bass, for that. So what I'm going to do now is to allow my participants, panelists, to just give closing remarks as we bring this to a close, so that we can give room for question and answers, if any, and then I hand over to Rolake. So let me start with Eric. Eric, do you have any closing remarks? Just in a minute or two.
Yes, so just in summary, I think as we've seen from all the participants, the regulation has actually helped the industry, and it's going to help the industry quite a lot, bringing more competition into the industry and making it a lot more efficient. For us, for me at least, as an investor, what this creates is a lot of opportunities for us to look at some of the best players and the more competitive players in the industry to deploy capital towards supporting those players. But more importantly, too, it's the soft issues are coming to play a bigger role in actually investors like myself investing. So while you work out your businesses and increase some of the efficiencies we talked about, looking at some of the soft issues like the ESG issues we talked about earlier, it's an important part going forward for an investor like myself to invest in businesses in this sector. Thank you.
Okay, Funsho, final words from you.
Yes, I would say first will probably be, it's important to build a fortress balance sheet in a period like this. So I would expect that, companies will be looking at their, again, capital structure and ensuring that in there you have, commercial paper programs, you've got a bond issuance program, you have, your working capital, you've got, you're able to, raise long-term debt, but more importantly, you go and raise that equity that just ensures that you're not over leveraged. I think the second point, and I was just looking at the notes I jotted down, was that strategic M&A is important, to capture value across the industry verticals. And it's certainly, something that we're speaking to our key clients about. And then the third is that, the markets are open. I mean, this is the best debt capital markets that we've seen, or best debt capital market conditions we've seen in the history of the Nigerian capital markets. So there are pools of liquidity available to businesses to chase growth opportunities, but trust is key. That's the one thing that investors are looking out for. They need to be able to trust that you will do what you say you will do. And lastly, obviously, I think it's something that businesses need to watch out for, but the equity capital markets, all the market indicators are pointing towards a reopening of the equity capital markets, just given where interest rates are. So if you're thinking about raising equity capital, now probably seems like over the next 12 months will be a good time to, to approach the market to raise equity capital. I'll stop there.
Okay, thanks so much. Timothy, final word.
Sure. I think the future for gas is bright. It will fast track our industrialization in our country, as well as the region. But we also need an adequate pricing framework, to support building out the infrastructure that we need to get to every industry that needs the gas. And finally, I think we need a clear and supportive, consistent regulation to drive this process.
Thank you. Clear, consistent regulation to drive the business. Okay, that's noted. Mr. Abbas, final word from you, sir.
Great. Thanks. I think for us, I would say we should strive to continue to support the market. We should see how we can, whatever we can do to collaborate with other stakeholders, especially in this interesting period, and especially for the oil and gas sector, to see more of the likes of global offers in our market, more of surplus like coming to our market to really raise funds domestically, both in equities and in the debt side, and to be able to see how we can really have a good story to tell. Let's say giving ourselves a kind of short-term horizon in the next 2-3 years, for instance. What kind of market do we really need to see in place? What kind of, how do we encourage, this kind of sector to really come into play, given the fact that, there's PIB in place and other policies of government that seem to be in favor of that sector. I think it's something that we should think of, and we should think of how we can collaborate as market stakeholders.
Thank you very much. Mr. Mahmoud, final word.
Thank you, Pedro. I think Nigerians should embrace deregulation. We shouldn't be scared. I'm excited that government has finally begun to speak positively about deregulation. It was always a political taboo. That word was always avoided. And we should basically not be scared. Look, we sell PMS in Nigeria at about 160 naira per liter. In Chad and Niger, it is at 365 naira per liter. So that encourages some sort of cross-border transaction. Those countries are still surviving. We are a gas nation that is currently producing oil. If we want cleaner, cheaper alternative sources of energy, then we can't have subsidized sources of energy like PMS competing with CNG and LPG, etc. So I think deregulation should be embraced. M&As are going to come up. Certainly there's going to be consolidation in the sector. I used to always joke that PPMC, as it was then, I used to call it the People's Petroleum Marketing Company, because everybody was a marketer. Everybody was in oil and gas. So I think we're going to see that consolidation and have more serious players, which will then bring the efficiency we're looking for, which will then drive down prices. We're talking about per second billing today, right? We used to talk about, we were charged for airtime per minute. It was competition that brought about per second billing. The same competition will drive down prices in the downstream sector. So once the market is deregulated, international players will come in, the right capital structure will put in place, longer term structure will put in place, pipelines will be built, the roads will become safer, and we should just embrace it. Government has no business in business. Nigerians will be surprised that 13 naira per liter is given to government every day out of that 165. And these are agencies which were previously funded by government, who are now told to go and fend for themselves. So therefore, we're paying for overheads. Why should we be doing that? What value do they have in the new dispensation? So let's embrace deregulation. Let's open up the market. We shouldn't be scared about short-term hikes in prices. Is the ordinary man driving an SUV? Is the ordinary man have a fleet of cars in his houses? Those are the people that have been subsidized by subsidies. So let's deregulate the market, let's open it up, and Nigeria will be better in the long term for it. Thank you.
Okay, great, Mahmoud. You just answered one of the burning questions in the Q&A box that says, what's the economic benefit of deregulation? I think you answered it, so I'm not going to ask that question anymore because that's fairly and adequately answered. Olumide, final word from you.
Sorry, Pedro, if I may add.
Yes.
We spend 1 trillion naira a year on subsidy. So if the market is deregulated, If that 1 trillion naira about economic benefit, housing, education, health, that's economic benefit. That's where the monies can go to.
Absolutely. Okay, great. Olumi, the final word from you. Please remember to unmute. Unmute.
Thank you. Wow, I feel like it's all been said. Really, look, we are in a perfect storm of opportunity. If the regulators make good on the promise of the government makes good on the promise of consolidation, then there's opportunity there. My friend Mr. Abbas has proven that actually there is a transition happening. Our regulators are recognizing their roles, not just as enforcement agencies, but as enablers of business. And some of the things he has mentioned really are encouraging, because it's all about creating the right environment for investment, the right investment for market operators to participate in. For us market players in the downstream retail, like I said before, a lot of investment has gone into this, and I think it's only fair that these people who have truly invested in steel, in infrastructure in Nigeria, are allowed to actually capture some margin. You get more margin from selling a bottle of water today than you do selling petrol. And that's, that's quite shameful. But what I see is that part of that investment, that part of the margins that I captured, these guys have already proven that they're investors in the sector. We have proven that. The margins we make will allow us to invest in the next, or participate in the energy transition properly, such that we are creating that framework that my colleagues at the IFC like to call a triple bottom line, which is that we are able to address socioeconomic benefits, job creation, employment opportunities. We're able to address margin as a bottom line. We're also able to address the environmental issues that come with the business and the industry that we participate in. This should be the year of transition. It's a year of gas. Gas is definitely on the roadmap. Thank you very much.
Okay, thank you so very much, Mr. Olumide. Thank you for your time. Mr. Mahmoud, thanks for your time. Mr. Abbas, we're grateful for your time. Thanks for your time. Eric, I think it's been a wonderful meeting this afternoon. I'm going to hand over to Rolake. Once again, we thank the Nigerian Stock Exchange for inviting us to participate. It's been an opportunity. Rolake, over to you as we bring this to a close. Thank you, Rolake.
Thank you very much for that, Pedro, and to all the panelists on the Downstream session. It was quite an engageful and insightful, lots to say about the industry and lots of work to do, but we're optimistic that with all our collaboration, we can move this industry forward. Benjamin Franklin once said that an investment in knowledge pays the best interest, and I hope you've all found this entire webinar to be time well spent, valuable and insightful. Before I hand over to the divisional head for listing business at NSE, Mr. Olumide Bolumole, I'd like to leave you all with a few key high-level takeaways from today's discussion. We heard from the NSE CEO, Mr. Onyema, on some of the innovative financing structures that the exchange is helping to pioneer. We also heard from the GMD of NNPC, represented by Mrs. Rose Escher, the GGM for Finance, on the work NNPC is doing to try to move the industry forward, particularly in the gas sector. Then His Excellency, the Honorable Minister of State for Petroleum Resources, also gave his high-level opinion on what the government's role is going to be in helping to boost the prospects for the development of the industry. We had the pleasure of hearing from Alex Bagansky of RenCap on global oil markets and his $50 average oil price forecast over the next 5 years. The president of the NGA, Mrs. Audrey Joe-Ezigbo, also gave her view on the key initiatives in the gas market and the need for collaboration across all stakeholders. There was a lot of reference to the strong ESG requirements for financial reporting in the sector, the need for greater cost efficiency across all parts of the value chain, and specifically for Nigeria, the importance of energy security and independence. We also heard about how the capital markets and financial institutions could work more collaboratively together to help fund and underpin the financial strength and health of the sector. Of course, the PIB always comes up in discussion. We understood the urgency of that, and we also understood the importance of dialogue between the regulators and the operators. All of this will not be in vain because it will all come together, hopefully to make for a stronger and more resilient and sustainable oil and gas sector that will contribute to job creation and broader economic development. So we'd like to encourage you to continue the engagement. Our panelists, please respond directly, especially the downstream panelists, to some of the questions in the Q&A box. And I will now like to hand over to Mr. Olumide Bolumole to give the closing remarks on behalf of the NSC. Thank you very much.
Good afternoon, distinguished ladies and gentlemen and panelists. I think it's fair to say that we've had a really, really robust session. It's lasted a little longer than we anticipated, but I think it just shows the seriousness of the sector and the opportunities that exist in the sector. Acknowledging all our panelists, acknowledging the Honorable Minister, acknowledging the DG of the SEC, ably represented, acknowledging all the speakers. We wanted to thank you for your contribution. We would also like to acknowledge the CEO of the Nigerian Stock Exchange, Mr. Oscar Onyema, for hosting this event. We want to appreciate the panelists for their contributions. I think it's important that we say a big thank you to Rolake Akingbefilani for excellently facilitating this webinar. I think it's fair to say that she did an awesome job and an excellent job in this really useful and robust conversation. Please note that we'll be sharing various slides to all the attendees that requested it and registered for the event. Thank you again for participating, and please continue to stay safe. Note that the Nigerian Stock Exchange continues to find platforms like this and spur platforms like this to, I guess, to get the conversation going between public and private sector for the growth of specific sectors. And today, the opportunity that has been presented in the oil and gas sector are clear, and we stand ready to support all the operators in achieving their future, the strategic business and future objectives. Thank you.
Thank you, everybody. Until next time, we wish you a good day, stay safe, and have a good rest of the week. Thank you very much. Thank you, Olumide.